Hello everyone, welcome to Study IQ. So in this video, I will bring to you the banking awareness for the month of July. This is set 1 in English. Let's start the video. So July banking awareness, I will cover it in two parts. In the first part, I will cover all the RBI circulars of the entire month. And in the second part, I will cover the MCQs. So this video is dedicated to all the RBI circulars from 1st of July to 31st of July. Let us start with the circular that is about cyber resilience and digital payment security controls for non-bank payment system operators. Now, this is a circular that came on 30th of July 2024. So, first of all, let's go step by step. What is the meaning of payment system operator? Who is a payment system operator? Payment system operator is basically a company. It's like an intermediary which facilitates payments, digital payments, online transactions, right? So payment system operators, they are companies that facilitate, process and settle payments between different parties by making sure that there is a flow of funds in the online transaction. So they play a crucial role in the digital payment ecosystem. Now, Reserve Bank of India says that there are two types of payment system operator. One is a bank, of course, the banks provide you all the payment settlement online. You must be doing RTGS, NEFT, you must be doing using wallets of different banks. And one is a non-bank payment system operators, right? So, for example, if I talk about Razorpay. Now, Razorpay company is a payment system operator. It is providing you payment gateway services. But is it a bank? No, it's not a bank. So, it is a non-bank payment system operator. So, payment system operator are of two types. So what does RBI say? RBI is saying that even the non-bank payment system operator, they should have a lot of cyber security. They should be resilient to the cyber attacks, and digital payment security controls have to be there. And these directions, they have been issued by the RBI under the Section 10(2) and Section 18 of the Payment and Settlement System Act of 2007. So these directions are issued by the RBI under Section 10 and 18 of the Payment and Settlement System Act of 2007. So let's understand this in detail. Now RBI has given a classification of payment system operators. So let us take a look at the classification first. So this is the classification of the RBI of all the payment system operator. One is the large non-bank payment system operator. Of course, when I'm talking about this circular, I am only talking about the non-bank payment system operator. So one is the large, one is the medium, and one is the small. So which companies come under large non-bank payment system operator? We have the National Payment Corporation of India, that is NPCI. We have NPCI's company called Bharat Bill Payment Limited. We have the Clearing Corporation of India. We have the card payment networks, non-bank ATM networks, white label ATMs, white label ATM operators, large PPI issuers, prepaid payment instrument issuers, trade receivable discounting systems operators, Bharat Bill payment operating units, and payment aggregators. Payment aggregators like Paytm, for example, PhonePe. So all of these, all of these are large non-bank payment system operators. Let us talk about medium non-bank payment system operators. So cross-border money transfer operators under the Money Transfer Service Scheme and medium PPI issuers. They are considered medium non-bank payment system operators. The people who are engaged in MTSS, Money Transfer Service Scheme, and medium PPI issuers. Then we have small PPI issuers and instant money transfer operators. They are considered small non-bank payment system operators, right? So why I'm saying you this is because the timeline that Reserve Bank of India has proposed depends on whether you are large, medium or small. So these master directions, these master directions by the RBI, they are called RBI Cyber Resilience and Digital Payment Security Controls for Non-Bank Payment System Operator, and they will come into effect on these dates. So this is the deadline, you can say. By this time, the necessary infrastructure for making sure that you have a good cyber security and you have digital payment security control. You have to implement that. So if you are a large non-bank payment system operator, then you have to do it by 1st April 2025. If you are medium non-bank payment system operator, you have to do it by 1st April 2026. And if you are a small non-bank payment system operator, you have to do it by 1st April 2028. And you can see the large non-bank payment system operator has been given the least time because they are engaged in digital transactions for millions of people. And if they suffer any cyber attack or they lose any security control, then it can affect a large range of people. So that is why they are given the least time. And also large non-bank payment system operator, they have a lot of money, they have the means, the resources, so they should be able to do it in a less time relatively. Now the non-bank payment system operator, they are mandated to promptly inform the RBI of any unusual incident. Unusual incident like recently you must have seen there was a company called Sea-Edge Technology. Sea-Edge Technology is a company that was attacked by a ransomware. Now look, Sea-Edge is not a payment system operator, but I am just giving you one example. There was a cyber attack, right? Sea-Edge is a joint venture between State Bank of India and Tata Consultancy Services. So there was a ransomware attack and it has to be reported. If any such attack happens on a payment system, non-bank payment system operator, then it has to be quickly informed to the Reserve Bank of India. So what all the things have to be informed to the RBI, like cyber attacks, outages of critical system. Can you give me an example of outage of critical system? We recently saw the outage that happened in Microsoft, right? I will cover that in detail in this video also. So that was outage of critical system, outage of any infrastructure, internal fraud, settlement delays, all of these things, right? And also they are directed to report any cybersecurity incident to CERT-in as well. What is CERT-in? Indian Computer Emergency Response Team. IN means Indian Computer Emergency Response Team. This is an organization. This is the main cyber security organization of India, and it works under the Ministry of Electronics and IT, MeitY. So not only the non-bank payment system operator, they have to inform to RBI, but they also have to inform to CERT-in. Also, the non-bank payment system operator, they have to put in place a very comprehensive data leak prevention policy for confidentiality, integrity, availability, and protection of the business and customer information, both in transit and at rest, for data available with it or at vendor managed facility, commensurate with the criticality and sensitivity of the information held or transmitted. And the payment system operator, they should also implement a real-time or near real-time fraud monitoring solution to identify suspicious transactional behavior and generate the alerts, right? So that is what they need to do. Now there are some best practices which have been told by the RBI. So for example, when sending alerts via SMS, email or other notification, the payment system operator and their participants, they have to ensure that sensitive information like bank account and card number is masked. Okay, it is masked or it is redacted. It is hidden. So you must have also noticed, if you are receiving a message from Paytm, if you have made a transaction with Paytm, they will send you SMS. In that, none of your sensitive information will be visible. If they are mentioning your bank account number also, only 1 or 2 digits will be visible to you. Rest they will hide by using this XXX like that. So the sensitive information when sending alerts via SMS, email, then all of your sensitive information like bank account detail, card number, it has to be masked. Online payment transaction must clearly display the merchant's name and the transaction amount, while OTP based authentication messages should include the OTP at the end and refer to the specific transaction. This is what RBI said in the master direction. All of this basically is the common sense. Okay. Insofar as the MCQ is concerned, you have to remember the deadlines for large, medium and small non-bank payment system operators, right? And also all the payment system operators, whether bank or non-bank, they have to provide facility on their mobile app and website both, where customers can report fraud transactions immediately. Now this is very important because in the exam you can be asked what is PCI P2PE and PCI PTS. So for card payments like credit card, debit card payment, etc., these are the security measures. So the payment system operators, they must ensure that terminals which are installed at merchant locations for capturing the card details are validated against the PCI P2PE. For example, if you are going to Big Bazaar and you have done a shopping of 10,000 rupees, now you want to pay it using your credit card or debit card. So what you will do, on the Big Bazaar there will be a reception where there will be POS terminal, point of sale terminal, there will be POS machine. You will swipe your card here. So what are they doing? They are capturing the card detail. Merchant location, right? So Big Bazaar is a merchant. So Big Bazaar has point of sale devices where your card data will be captured. So it should be secured. It should be secured with PCI P2PE, that is Payment Card Industry point-to-point encryption program. Point-to-point encryption. So your card data will become encrypted. Okay. Next, the point of sale terminals with PIN entry for card payment must be approved by the PCI PTS. What is PCI PTS? Payment Card Industry PIN Transaction Security Program, ensuring that they meet the highest security standards. So you did two things. First, you swiped your card. Okay. Now that time it should be protected by PCI P2PE. Then the second step will happen. You will enter your PIN. Once you swipe your card, it will ask you for your PIN. So you will enter your PIN. That time it should be approved by the PCI PTS. And remember the full form of both PCI PTS and PCI P2PE. So PCI PTS is Payment Card Industry PIN Transaction Security. So if these two things are a part of the payment infrastructure, you can be assured that higher security standards are being followed by the merchant and the payment system operator. Okay, so it is incumbent upon the payment system operator to provide PCI P2PE and PCI PTS. Now next circular is 30th of July 2024, and it talks about the treatment of the willful defaulters and the large defaulters. Now, first of all, you need to understand who is a willful defaulter. A willful defaulter is a person who has money, but he still does not want to pay to the bank back. So for example, if there is a person, he has taken a loan of 5 crore from the bank and he has the means, he has the assets in order to pay back to the bank, but by his own will, by his own volition, by his own approval, he does not want to pay back. He flees the country or he runs away. So such person is called willful defaulter. But there is always a amount above which we call him a willful defaulter. So what is that amount? Now that I will tell you. So this is the master direction on the treatment of the willful defaulters and the large defaulter. So for willful defaulter, the amount is 25 lakh plus 25 lakh or more. And for large defaulter, the amount is 1 crore plus. So willful default means what? The borrower has the capacity to honor the obligation, that is to honor the debt servicing or to pay back the debt, but he still chooses not to. Or if the borrower has diverted the funds availed under the credit facility from the lender. Or if the borrower has siphoned off the funds available under the credit facility from the lender. So all of these, the borrower has disposed of immovable or movable assets provided for the purpose of securing the credit facility without the approval of the lender. So for example, if there is a person, he has put his land as a collateral in the bank and taken a loan. Now, without the approval of the bank, he sells off the land to some person and runs away. So all of these type of people are called willful defaulter. So willful defaulter is a person, a borrower or a guarantor who has committed a willful default. That is willful default. I have already defined what is a willful default, and the outstanding amount is 25 lakh and above. Outstanding amount is what? 25 lakh and above. So keep that in mind, that 25 lakh and above is the amount for identifying a person as a willful defaulter. So two conditions have to be satisfied. One, he has to commit a willful default, and second, the amount should be, the loan that he owes to the bank should be more than 25 lakh or more. So what to do with such person? So first of all, you have to identify, you have to review the account for the identification of willful default. And how to do it? Well, first of all, obviously the account will become a non-performing asset, right? And after that, within 6 months, so let's say you are a bank, you are State Bank of India, and you have given a loan, okay? You have given a loan, and the loan, the principal or the interest has not come for 3 months. Then what do? You declare the account as a non-performing asset. Now let's say you declared the account as a non-performing asset on 1st of October. So you are given a timeline of 6 months. So from the date when you have classified an account as an NPA, within 6 months, so by 1st April 2025, on 1st October 2024, you declared the account as a non-performing asset account. Then within 6 months, you have to declare the person as a willful defaulter. So how much time you get? You get 6 months. Okay, you have to declare the borrower as a willful defaulter within 6 months of the account being declared as a NPA account, right? Now what do you do if a person is a willful defaulter? You inform the RBI, right? You publish the photographs. So based on the facts and circumstances of the case, the banks can examine whether initiation of criminal proceedings against the willful defaulter, so whether to undertake criminal proceedings or not will depend on case-to-case basis. Okay, you publish the photographs of the willful defaulter so that the other banks become wary of such people and they don't give loans to such people, right? So you publish all the photographs and everything about the willful defaulter. Now let's talk about the large defaulter. Who is a large defaulter? So again, large defaulter is a person who is not returning the money. What is the threshold for calling a person a large defaulter? 1 crore or more. 1 crore or more. For willful defaulter, it was 25 lakh or more. For large defaulter, it is 1 crore or more. If a person owes 1 crore or more to the banks and he is not returning, he is a large defaulter, right? So first, and let me tell you how to determine whether the 1 crore, whether it is the principal or the principal plus interest. Tell me that. Well, both. Principal and interest. So that is what the RBI is saying. You apply the interest also, right? When you calculate 1 crore. So let me give you an example what I mean to say. Let's say if a person has taken a loan of 90 lakh and he has not returned for 1 year. Okay. Now let's say the interest rate is 15%. Okay. So 90 lakh and 15% of 90 lakh is 15 lakh, right? So 15% of is 13.5 to be precise. Okay, I don't want to go into calculation part of it. But now he owes how much? He owes more than 1 crore. 90 lakh plus 13.5 lakh is how much? That is 103.5, right? 103.5 lakh, which is more than 1 crore. So when you calculate 1 crore amount, you include the principal and interest both. So now he becomes a large defaulter because he owes, yes, the initial loan that he took was 90 lakh, but now he owes more than 1 crore. So he is also a large defaulter, right? So large defaulter also, again, the same thing. You have to inform it to the credit information companies. So if a person is a large defaulter, the credit information company, and I told you credit information companies are how many in India? Well, credit information companies in India are 4. CIBIL, then Experian, then you have Equifax, and of course you have the CRIF Highmark. CRIF, CRIF, Highmark, MARK. These are the 4. So let's say State Bank of India has identified a large defaulter. Then what State Bank of India needs to do? State Bank of India will send the person's detail to the credit information company. And then the credit information company, what it will do? It will send the detail of the large defaulter to all the other banks, all the banks, all the credit institutions. So you can see here, that these directions which I'm telling you about, they apply to all the lending institution. They apply to the commercial banks like small finance bank, local area bank, regional rural bank. Payment banks cannot give loans, so obviously it will not apply to that. But cooperative banks, the state cooperative bank, central cooperative bank, even the All India Finance Institution, there are 5: Exim Bank, NABARD, NHB, SIDBI, NABFED. So BFC, housing finance companies. So basically all the lending institutions, they are told about the willful defaulters, especially the large defaulter, right? Large defaulter. So that is what is there in this circular. Nothing fancy, right? Nothing fancy. Now, so all the entities regulated by the RBI, including all the banks, etc., shall submit the information to all the credit information companies in respect of the large defaulters at monthly intervals. Okay, so at monthly intervals, after every 1 month, the information needs to be updated, like who are the new large defaulters during that 1 month time. So every month, all the lenders, whether it is NBFC, bank, small finance bank, they need to send the information to the credit information companies about who are the large defaulters. Understood that? Now, there are some other rules which have been announced by the RBI, and these are about the investment. These are about the investment, overseas portfolio investment. Overseas portfolio investment. What is overseas portfolio investment? You must have heard about FPI, foreign portfolio investment. It is just the opposite of that. In a foreign portfolio investment, the foreign people are investing in India. They are investing into the Indian stock market, the companies which are listed. They are investing short term in that. Similarly, OPI is just the opposite. When the Indian residents, they are investing in the companies abroad, or if they are occupying any equity, any ownership in the company abroad. So what is the rule? How much you can invest in a company abroad? Again, same limit. That is the limit for the liberalized remittance scheme. And how much is that? 2,50,000 US dollar per year. 2,50,000 US dollar, 2.5 lakh US dollar is the amount that you can invest overseas without the intervention of the RBI or anyone else, central government. Because this is the spend limit that you have under the liberalized remittance scheme. So same is there. The resident individuals of India, they can make overseas portfolio investment with the same limit as that of the LRS, that is 2.5 lakh dollar per year. Also, let's say you are a very hardworking fellow, okay, and you are working in a company in Singapore. Now that company in Singapore is so impressed by you that they have given you 3% equity in the company, which means you are the owner of 3% of the company, right? So, or you are given ESOPs, employee stock options worth 3%. So again, you will have equal to 3% of the company ownership, right? So in any case, if it is less than 10%, so up to 10%, if you are an Indian person and in a foreign company, if you have employee stock ownership plan, ESOPs, right? Or if you have equity, if you have shares, if you have any equity. See, for all practical purposes, share, stocks and equity, they mean the same thing. If you say I have 3% share in the company, that means you have 3% stocks or 3% equity, or you have 3% ownership, it means the same thing for all practical purposes, right? So up to 10%, if you have up to 10% ownership or 10% stock or 10% equity or 10% ESOPs in a company, and you don't have control, you don't have the management control, you have up to 10%, that will also be qualifying as a OPI. That is also be considered as a overseas portfolio investment. Okay, overseas portfolio investment. So these are some criteria which are told by the Reserve Bank of India. Let me repeat in 5 seconds. If you invest up to the limit of liberalized remittance scheme, which is 2.5 lakh US dollar, 2,50,000 US dollar, or if you have up to 10% ownership in a foreign company without the management control, okay, so whether it is a listed company or unlisted, doesn't matter. So even abroad they have stock exchanges, right? So let's say Singapore, you get 3% ownership of a company in Singapore without management control, that may be listed on the Singapore Stock Exchange or not, doesn't matter. then and without management control, that will also qualify as a overseas portfolio investment. I hope that made sense. Another thing which Reserve Bank of India has told, if you are investing, if you have a financial commitment, if you are an Indian company or Indian individual, if you are investing more than $1 billion, $1 billion, if you are exceeding $1 billion or its equivalent in a financial year, then you have to take the permission of the RBI. You have to take the permission of a RBI. Okay. If you want to invest more than $1 billion in a company abroad, you have to take the permission of the Reserve Bank of India. So this is very, very important. All these rules which RBI has set. Okay. Now let's come to the guidelines on treatment of dividend equalization fund for the primary urban cooperative banks. You know what are primary urban cooperative banks, nothing fancy about it. Now, urban cooperative bank, you know, a lot of them, what they do is they create a fund which is called dividend equalization fund. Okay, what is the meaning of this? Let me explain. So let's say there is a cooperative bank. So this is a cooperative bank. Okay. Now it is listed on the stock exchange and the shareholders, and let's say it is making good profits. So one part of the profit they distribute among the shareholders, right? So that is called dividend. The part of the profit that is distributed among the shareholders is called dividend. So for this year, 2023-24, the year that has just ended, the bank created a fund called Dividend Equalization Fund, where it puts in certain money, and the bank is saying that what if next year, so current year that is going on 2024-25, let's say the bank runs in a loss. Now when the bank runs in a loss, obviously it is not in a position to distribute the dividend. So what some banks do, they create a fund called Dividend Equalization Fund, and from this fund they give the dividend in the future years if the bank goes for a loss or if it makes very less profit. But that is not allowed. RBI is saying that is not allowed. Why? Because you have to distribute the dividend only from the profits of that particular year. You cannot give dividend from the profits of the preceding years. Okay, so that is what is the rule. So they have clarified here that it is observed by the Reserve Bank of India that some urban cooperative banks, what they are doing, they are creating dividend equalization fund. So for example, if this year was very good, 2023-24, you made a good profit. So from that profit, you can put 50 crore into the dividend equalization fund so that this 50 crore you will use to give dividend next year. That is not allowed. That is not allowed. So banks are doing this a malpractice. So dividend equalization fund through appropriation of profits. Now this year what they did, 2023-24, the year that has just ended, they put 50 crore, they appropriated the profit, some part of the profit they put into the fund. What was their intention? With an intent to utilize these balances to pay dividend in the future years. Which future year? When the profits are not sufficient or when the bank has posted a net loss. But this is not allowed. Okay. Now another thing which RBI has made it absolutely crystal clear. You know, you cannot pay dividend. RBI prohibits dividend payment from previously accumulated profits or reserves like this dividend equalization fund. And RBI says it is compulsory, it is mandatory that dividend can only be paid by the banks from net profit of the current year. Understood now what I mean to say? Second thing, the banks, what they are doing is they are considering this dividend equalization fund as their tier 2 capital. No, this is not allowed by the RBI. You consider it as a tier 1 capital, not tier 2. So this also is RBI, is what RBI is saying. What RBI is saying? RBI is saying that why are banks considering it as a tier 2 capital? After all, it is their profit. It should be declared as a core capital. Why banks declare it as a tier 2 capital? Because when the losses come, tier 1 capital absorbs the losses, right? So some bank may think that, okay, let's not absorb the losses from the main capital. Let's tell RBI that, look, we don't have sufficient tier 1 capital and we will see what we do of this loss later on. So banks are always trying to cheat the RBI. Banks are always trying to trick the RBI, but RBI has made it very clear. RBI has said that if you have created dividend equalization fund, what you do, you send this money into the general reserve or free reserve, and the credit balance in the general reserve or free reserve shall qualify as tier 1 capital. Tier 1 capital. So RBI is much smarter than the banks. Okay, now let's come to a very technical circular that came on 29th of July 2024. What does this circular say? Well, it talks about fully accessible route. Okay, fully accessible route. Let's say you are a foreign person. Okay, you are this foreign guy and you want to invest in the Indian securities, Indian government securities. Can you do? Yes, you can do, but only up to 6% of the outstanding stock. What is outstanding stock? Outstanding stock means the securities that are available for being invested in. So that you can do, but only till 6% of the outstanding stock. Now, what RBI did, now this is the general rule, okay? This is the general rule. But RBI, they started something in 2020. What is that? They started a new route called fully accessible route. Fully accessible route, FAR. What is that? As the name says, fully accessible. Here you can invest unlimited amount of money into the government security without the permission of the RBI. For that, fully accessible route was created. Now you will say, what happens to this limit? So that is the thing. See, government issues a lot of securities. Okay. Some security they will put under FAR. Some securities they will not put under FAR. If government thinks that, look, we need more money for this security, then they will put it in the FAR so that the foreign people can invest unlimited amount. But if the government wants limited investment in some security, they will not put into FAR. That is what it happens, right? Now, and time to time, government can put some securities in FAR if they want more investment, and they can take out some securities from FAR if they want less investment. Because if they don't keep any security in FAR, then that 6% limit applies. Okay. Therefore, now what government has done, there are two securities. Okay. One is maturity period of 14 year and one is a maturity period of 30 year. So what they have done, they have excluded these two securities from FAR. So it has been decided by the government to exclude all the new securities of 14 year and 30 year tenure from the fully accessible route. Does that mean that the foreign people cannot invest in these securities now, 14 year and 30 year maturity securities? They can, but overall limit of 6% will apply. So here you can see that the investment by the foreign portfolio investor in the new government securities that will come for 14 year and 30 year tenure issued from now on shall be reckoned under the FAR that exists for regular government bond. Okay, so they are excluded basically. This tough language means they are excluded. Okay, so the foreign investment limit is there, right, for regular government bond. But if a government bond or government security comes under FAR, unlimited, there is no limit there. But now it is excluded from FAR, so there will be a limit. How much will be the limit? So the existing foreign investment limit for regular government bond cap overseas investment at 6% of the outstanding stock. 6% of the outstanding stock, right? So this limit will apply. Now, one very interesting thing I want to tell you here, when this thing happened, that the FAR route was started in 2020. So, the foreign people, they started putting in a lot of money. See, ultimately, if you see in the government securities, what is the interest rate that you are getting? You get 6%, 7%, 8%, something in that range, Most of the government securities that I have personally seen, you get like 7.3, 6.8, 6.73, which is a lot. Don't compare it with the Indian FD or what we get in India. Think about the foreign people. You will be surprised in foreign country, if they put money in FD, they get what? 1%, 1.5%. In Japan, they are getting 0.1%, 0.2%. So abroad, people don't put money into the FD because they get almost nothing. But in India, you get a lot of money. You get a lot of interest. So 6, 7, 8%. So foreign people, they starting when FAR route was opened by the government of India, by the RBI in 2020, right? So foreign people, they started putting money so much into the Indian bonds. And that is why what JP Morgan did, JP Morgan, they included the Indian government securities in their index. So the Indian government bonds, they were included in 2023. That announcement was made in 2023 by JP Morgan. So JP Morgan is a very, very large, it's one of the largest banks in India, if not the largest, the world. It is the largest financial institution in the world, let's put in that way. So JP Morgan, they have an index called Government Bond Index for the emerging market called GBIEM, Government Bond Index. So JP Morgan announced in 2023 that I will include the Indian government securities, Indian government bonds in the my own index. And therefore what started happening was the confidence increased like anything, because JP Morgan is JP Morgan. It is the best bank in the world, largest bank in the world. So the foreign people, the Indian government securities gained credibility among the foreign investors. So Indian government bonds are included in the Government Bond Index Emerging Market by JP Morgan. And finally, they announced it in 2023, and now they have started doing it from 28th of June 2024. So inclusion will occur over a period of 10 months, and every month 1% weightage will be there. So India will have how much weight in the JP Morgan EM bond index? 1%. Okay, this index is made up of the government securities of all the countries, most countries, good securities. India's weightage will be 1% for now, but it will increase by one, like, so 1% will be now for June 28, but they will keep increasing it 1% every month. So in 10 months period, it will become 10%. It will become 10%. And what is this 10-month period? It will start from 28th of June. It will start from 28th of June and it will end on 31st of March. 31st of March 2025. If you calculate, this is 10-month period. 10-month period. Understood what I'm trying to say? So JP Morgan first announced it on 21st of September last year 2023 that they will start including Indian government bonds in their emerging market index, like GBIEM and all this, and finally they are doing it. So 1% weightage per month, and for 10 months how much weightage will be there? 10%. And this can come definitely in the exam as an MCQ, that what will be the weightage of the Indian government bonds on the JP Morgan index for the emerging market. You say 10%, because in 10 months it will increase from 1%. It is 1% weight per month. See, if they ask per month, answer will be 1%. If they ask overall, the answer will be 10%. Now let us talk about the bank finance against the shares and debentures. Bank finance against the shares and debenture. Look, primary urban cooperative banks. So let's say you own 50 lakh rupees of shares of Reliance. Can you take a loan against it? Yes, you can. Similarly, if you have invested in debentures, debentures are just like bonds only, right? The only difference between a bond and a debenture is that, the bonds cannot be converted to share, whereas debentures are two types: convertible debenture and non-convertible debenture. That we will talk about some other day, but just remember, in debenture also you get a fixed interest rate like the bonds. So bonds for all practical purposes are like debentures only. So let's say you have invested in shares or debenture. You can take a loan against it. You can put them as collateral and you can take a loan. So primary urban cooperative banks, what is the ceiling? So that is 20% of their owned funds. Okay. So, the loan, the finance against share and debenture will be a part of the overall package. Basically, what I'm trying to say, primary urban cooperative bank, they are advised that the aggregate of their all the loans against the security of share and debenture should be within the overall limit of 20% of their own fund. And when we say own fund, it is 20% of the tier 1 capital. 20% of the tier 1 capital. Now let me explain this to you with an example. Let's say there is a primary urban cooperative bank, okay, and its net owned fund is 100 CR. 100 CR. Now a lot of people, they are coming to this primary urban cooperative bank because they want to take a loan, and in lieu of collateral, they want to put share or debenture. So again, share and debenture, so many people are coming that they want to take a loan. Now to all these people put together, they may be 100,000, whatever. To all these people together, how much is the loan, maximum loan that this primary urban cooperative bank can give? It is 20% of the net owned fund capital. So maximum 20 crore. It cannot exceed more than 20 crore. Got it? So the loan that that a primary urban cooperative bank can give, the aggregate or to all the people, cannot be more than 20% of the tier 1 capital. Now let's talk about the small value loans for primary urban cooperative bank. This is a circular that came on 25th of July 2024. So it's a very interesting circular. So primary urban cooperative bank, they have a mandate by the RBI. What is that? the mandate is that, the mandate is that 50% of the loans, 50% of the loans that a primary urban cooperative bank gives should not be more than 25 lakh rupees or 0.2% of its tier 1 capital, whichever is higher. Whichever is higher. Got my point? But it is not easy for a primary urban cooperative bank to follow this rule. So that is why a timeline is given. What is that timeline? Timeline is that they have to make it 40% by 31st March 2025 and they have to reach the limit, the mandate by the RBI by 31st March 2026. Now let me explain again with an example. And this loan can be maximum 1 crore. So there is a primary urban cooperative bank and net owned fund of this is 500 crore. Okay. Now what is the rule of the RBI? The rule is that 50% of the loans, minimum 50% of the loans that primary urban cooperative bank will give should be 25 lakh, less than 25 lakh or 0.2% of the tier 1 capital of this primary urban cooperative bank to whichever is higher to a tune of 1 crore. Now, whichever is higher, okay, here the important word is whichever is higher, but that higher cannot be more than 1 crore. Cannot be more than 1 crore. So let's say there is a urban cooperative bank, the net owned fund is 500 crore. Okay, the tier 1 capital is 500 crore. So what is the 0.2% of that? 0.2% of 500 crore. Let us calculate 500 crore into 0.2. So that is how much? That is 100. That is 100. Divide by 100 because it is percent. So it becomes 1 crore. So 0.2% of 500 crore is 1 crore. Okay. Now, so a primary urban cooperative bank has to give 50% of the loans. Okay, 50% of the loans up to 25 lakh or 1 crore. Higher of the two. So which is higher, 25 lakh or 1 crore? The answer is 1 crore. So 50% of the loans, I repeat, 50% of the loans that a primary urban cooperative bank will give will be below 1 crore. Below 1 crore. Understood? Now let us say, and 1 crore by the way is the upper limit. Upper limit also. So let's say there is a primary urban cooperative bank. The net owned fund is 1000 crore. So what is the 0.2% of that? 0.2% of that is 2 crore. Am I right? So a primary urban cooperative bank, can you say that primary urban cooperative bank, 50% of the loans that it will give, 50% of the loans that it will give will be below 2 crore. Can you say like that? No, because 2 crore is more than 1 crore. So that remains 1 crore. So this 0.2% to a maximum of 1 crore. Okay, if the 0.2% is more than 25 lakh, then you take that sum, but up to 1 crore. So for a primary urban cooperative bank, let me repeat in 10 seconds. For any primary urban cooperative bank, 50% of the loans has to be below an amount which is the higher of 25 lakh or 0.2% of the tier 1 capital to a maximum of 1 crore. This is how I put it, and this is what you need to remember. But obviously, primary urban cooperative banks were saying that please give us some time. So RBI is saying, okay, do one thing. You make it 40% at least by March 2025 and please make it 50% by 31st March 2026. So you make it 40% by 31st March 2025 and you make it 50% by 31st March 2026. Now let's come to domestic money transfer. What is domestic money transfer? Well, domestic money transfer, the framework was introduced in 2011, right? So basically what happens, I'll tell you. Let's say you go to a bank and you give them 50,000 rupees cash. Cash, okay? So there are two words, cash payout and cash pay in. I'll come to that. What is cash pay out, cash pay in? So you go to a bank, person is sitting on a reception, you give him 50,000 and you give the number of a NEFT. You want to do an NEFT because 50,000 you cannot do RTGS. RTGS minimum 2 lakh rupees, right? So you do NEFT. You tell the bank that, look, I have a friend in Ahmedabad, in Gujarat. You please send the money to him. Okay. You give 50,000 rupees cash to the cashier and you say, please do NEFT. So what are the things that you need? You need your friend's bank account number, and you need IFSC code. That's it. That's all you need to know. And of course, they will ask you the name also. So you have given the name of your friend, account number of your friend, and IFSC code, and the bank will process the payment. The problem here is that, what about your identity? What about your identity? Right? Are you a money mule? See, sometimes, there is a word called money mule. What is a mule? A mule is an animal. Okay, when you basically crossbreed a female horse with a male donkey, a mule is produced, and a mule is used to basically carry stuff, logistics, transport the cargo from one place to another. That is why we use a mule, and mule is a sterile animal. Similarly, what is a money mule? A money mule, so for example, you receive a call one day and a person says, I will send some money into your account. Let's say your account is B, the person account is A, and you don't have to do anything. You just have to send that money to account C, and I will give you 10% of that. So you will think, oh, it's a great opportunity to earn money, because I don't have to do anything. This person will transfer money to my account, and I just have to forward it to some other account C, and I will get 10% of the money. You are a money mule. You are doing a activity, nefarious activity, unscrupulous activity for someone. You are like a money mule. You are carrying the illegal money on your load. You are taking the load of that. Don't do that. So similarly, this person can also be a money mule. He is bringing this cash, God knows from where, and he is sending it to somebody's account. So what RBI is saying is, now there has to be a very strict record keeping by the bank, right? Let's talk about cash payout. The remitting bank means the bank which is sending the money shall obtain and keep a record of the name and address of the beneficiary. So the friend to whom you are sending the money, his name, his address, everything, all the record will be maintained by the bank. All the transaction detail, the name of the beneficiary, address of the beneficiary will be maintained by the bank. That is cash payout, because bank is doing a cash payout to him. Now what about the cash pain? So the remitting bank, the business correspondent, they shall register the remitter based on a verified cell phone number and a self-certified official valid document as per the master directions of KYC norms. Also, every transaction by a remitter shall be validated by an additional factor of authentication. Now you went to a bank, you are giving the bank 50,000 rupees and you are saying, please give it to my friend from Ahmedabad. This is my friend from Ahmedabad. So what will the bank say? Bank say, look, I am sending you a OTP on your mobile number. This is to confirm your mobile number. So the verified cell phone number, remitter means the person who is sending the money. So the bank, what they will do, they will verify his cell phone number, right? And will take from him self-certified, his own signed Aadhaar card photocopy, his own signed PAN card photocopy. So his officially valid self-certified document they will take from him and keep it with themselves, right? And every transaction by a remitter shall be validated by AFA. So what the bank will do, bank will send a OTP to his mobile number and bank will say, what is the OTP you have received? Tell us that. So every transaction that he does will be validated by additional factor of authentication. Every transaction will be validated by, so this person cannot escape easily. Why? Because first of all, his mobile has been verified, and then his self-certified officially valid document and all these things are there, which will contain his address and his other details. All of these will be there. So it is not easy for him to escape. Also, the remitter bank shall include remitter details as a part of the IMPS or NEFT transaction message. Now this is very important. Sometimes what can happen, money comes into your bank and you don't know who has sent it. But now it will not happen. So the remitter bank, the bank who is sending the money to you, to your friend in Ahmedabad, they will include your detail, your name, your phone number, etc. So the remitter details will be sent to the beneficiary. IMPS, whether you are doing NEFT, so your data will be sent to the beneficiary also. So beneficiary will also get to know who is sending me the money. So it is not easy to become a money mule now. And lot of people are doing all this nefarious activity, and try to protect yourself. Okay, try to protect yourself. So this is how it is. Domestic money transfer, which was introduced in 2011. Cash pay in, cash payout doesn't matter. Now it will not be easy. Now let us talk about a circular from 10th of July 2024, and this is about the eligible credit rating agencies. Okay, there is a whole list that is given. Basically, Basel III norms say that you have to maintain 9% capital adequacy ratio minimum if you're a bank. They say that you have to maintain a good NPA ratio. So net NPA should be less than 6%. I mean, all those things are set by the Basel norms. So banks, what they need to do, it is always better to take ratings for the loans from credit rating agencies. Now they have updated the list of credit rating agency. So if a bank gives, so let's say there are 3 credit rating agencies, just to make you understand. And now the bank has added one more. Okay, these are the 4 credit rating agencies from which you can get your loans rated. So if a bank has given a loan of, let's say, 10 crore, what is the quality of the loan? How likely it is to come back to the bank? Will it become a non-performing asset? So loans can get rated by the credit rating agency. So for all the fresh loans that you are giving up to 250 crore, for all the fresh loans that you are giving up to 250 crore rupees, you take the rating from all the new agencies like ABCD, which is the list from any credit rating agency. Rating may be obtained from credit rating agency for those bank loans which are below 250 crore. That is 250 crore or less. They should not exceed 250 crore. That's it. You can take a rating for these loans. Now, let's say you have taken, earlier there were only 3 credit rating agency, A, B and C. So you have already taken, existing ratings are there. Okay, from A, B, C. Then what can you do? Well, then you can undertake rating surveillance irrespective of the rated amount till the residual tenure of such loans. So if you have given a loan, if it is still, the tenure of the loan is still remaining, so the credit rating agency may undertake rating surveillance irrespective of the rated amount. So the new agency D, if you want to take rating from the agency D, you can do it, and for that there is no limit on the amount. Now, provided that in case of the existing rating assigned to the working capital facility exceeding 250 crore, the CRA shall undertake rating surveillance only till the next renewal of such facility by the banks. Now, if the amount is more than 250 crore, and if you have already taken the rating from the old agencies, right, then the new agency will give you the rating only when the loan is renewed. So when for example, the money is coming back and you are giving it to someone else, or you are giving it to the same person, same company, that time. Basically, for all MCQ purposes, just remember the amount 250 crore, right? For those loans which are fresh, which are up to 250 crore, you can take fresh ratings for those. But if there are loans from which you have taken the ratings from the existing agencies, that list was not updated, the old agencies, you can still do it. You can still do it from the new agency irrespective of the amount. But if the loan is more than 250 crore, then it is better to take the rating when the loan is renewed. That is all this circular is saying. Now let's talk about the investment that is done by the Indian investors in the GIFT City, IFSCs, International Financial Service Center, like GIFT City. So there are many IFSCs in India. The most famous is the GIFT City in Gandhinagar in Gujarat, under the liberalized remittance scheme. Now, can you and me, ordinary Indians, can we open account in GIFT City? Of course we can. So we can make investment into the GIFT City, but it was allowed only for 2 purposes. What are those purposes? Number 1, making investment in IFSCs in securities except those issued by entities or companies resident in India. So for example, if you want to make an investment in companies, the foreign companies which have opened their offices in IFSC, so making investment in IFSCs in securities except those issued by entities or companies resident in India outside IFSC, right? So you can, remittances under liberalized remittance scheme to IFSCs can be made only for these 2 purposes. Okay. So liberalized remittance scheme, you know the limit already, 2,50,000, right? This 2,50,000 can you send to IFSCs? Yes. For what? For making investment. You can make investments within IFSC. You can make investments in those companies which have their offices in IFSC, number one, they can be foreign company, all right, but if they are foreign company, they have to be within IFSC. That is the entire point. If they are outside IFSC, you cannot make investment in that. And second, of course, if you want to pay for pay your fee to foreign university, if you want to pay to Harvard, Oxford, or any university, then if these are located in IFSC, then it is better you pay here only. Otherwise, you'll have to send money abroad and all. Now you can see that a lot of foreign universities, they are opening their offices inside the gift city because it is always better to pay here only, right? So for example, Deakin University recently opened, Australian University Deakin opened its office in IFSC. So there are various universities which are setting up. There are a lot of foreign institutions which are setting up their offices in the IFSC. So these were the only two reasons for you to send money, to remit money under the liberalized remittance scheme to the IFSC. But now some more have been added. So for example, you can invest into the financial services or financial products within the IFSC. If anybody is offering you any financial services or financial products, you can still send the money, right? So you can also do current or capital account transactions in any other foreign jurisdiction other than IFSCs through a foreign currency account held in IFSC. You can now open a foreign currency account in IFSC. You don't even have to open a account in Indian rupees. You can open a foreign currency account in IFSC, and you can do current or capital account transaction in any other foreign country, right? Even apart from IFSC, through a foreign currency account held in IFSC. So resident individuals, they can open foreign currency account in IFSC now. Resident individuals, they can open foreign currency account in IFSC, and with that foreign currency account, they can do current or capital account transaction in foreign jurisdictions. So basically, more facilities have been given to you insofar as the IFSCs are concerned. Now let's talk about a loan that was given to a country called Guyana. It was given by Export-Import Bank of India. This is a circular that came, that came on 8th of July, which was incidentally my birthday as well. So Exim Bank has recently given 2 loans to Guyana. Okay, they gave a loan of $23 million earlier for what? Well, $23 million loan was given to Guyana because they wanted to buy some aircrafts from India, right? They wanted to buy aircrafts from India. They wanted to buy Dornier aircrafts from India. So $23.37 million loan was given. Okay, for buying what? Buying Dornier aircrafts, which are manufactured in India by Hindustan Aeronautics Limited. So they wanted to buy 2 Dornier 228 aircrafts, right? And now they are getting another loan. This is a relatively small loan of just $2.5 million. And this they are taking a loan from Exim Bank for what? Because they want to set up a solar photovoltaic power plant at the airport in Guyana, which is called Cheddi Jagan International Airport. Cheddi Jagan International Airport. And look, Guyana is a very powerful country. Why? Because Guyana's capital is Georgetown, and Georgetown is the headquarters of CARICOM. Now, CARICOM is a group of 15 West Indies countries, 15 Caribbean countries, and it has 6 associate members also. So 21 countries. CARICOM headquarters is in Georgetown in Guyana. Now let us talk about draft framework on alternative authentication mechanisms for digital payment transactions. Very, very important circular. It came on the last day of the July, that is 31st of July 2024. Now what is the meaning of this alternative authentication mechanism? See, what is happening is basically if you are doing any digital payment, right? You are doing NEFT, you are doing RTGS, you are doing IMPS, doesn't matter, right? You are doing any digital payment, you are getting a OTP. Am I correct? If you are doing NEFT, right? If you are doing RTGS, if you are doing IMPS, all you are dependent on is a OTP. So for digital payment transactions, the additional factor of authentication is what? It is OTP. But problem is that now there are a lot of technological advancement. Reserve Bank of India is saying, yes, OTP is working satisfactorily. We are happy with OTP. It is okay. There is not much wrong with OTP. But times are changing. The technological advancements are taking place, and therefore we should have alternative authentication mechanisms as well. So now there is a framework that they will set up. Now, what are the factors of authentication that Reserve Bank of India is considering? First, something the user knows. It can be a password, it can be a passphrase, or it can be a PIN. For example, let's say you open State Bank of India website and you want to do a RTGS to your friend of 3 lakh rupees. Now, when you initiate the transaction, you get OTP. But let's say instead of OTP, you are told to enter a password. So something the user knows can be a additional factor of authentication. So it can be a password which is different from your login password of the bank. It can be a different password that you know, and this password is, you will use it again and again, so you will remember it, right? No need for OTP, because the problem with OTP is you need a mobile phone also. If you remember a password, then no need of mobile phone. You can simply use a laptop to make the payment. So I'm saying, if in case you want to use a laptop or a computer, okay, you can use a mobile app on the mobile phone, but instead of OTP, you can simply put another password. You can put a passphrase, you can put a PIN, similar PIN that you use for your credit card or debit card transaction. In that case, there is no OTP. When you make a payment using a credit card, what do you need? You just need a PIN. That's it. Similarly, when you withdraw money from ATM, what do you need? You need a PIN. So why not use that even for digital transaction? So something the user knows can be used. Second, something the user has, like a card hardware or a software token. So a software token or a card hardware can be used. Something the user has can be used as a additional factor of authentication. Let's say if you have a card with you, that card you just tap, on your computer screen or on your mobile phone or something like that, and the payment can be made. So instead of OTP, you can use a card hardware or a software token also. Similarly, something that the user is, like a fingerprint or any other form of biometric. You must have done Aadhaar enabled payments. There they use your biometric. So why not use it in RTGS, IMPS and all? So can we use fingerprint as an additional factor of authentication? It is unique to every individual. Can we use biometric like your iris scan of the eye? Iris scan, all these things, can be used. So this is what Reserve Bank of India is working on, and I'm sure that in the coming days, any of these additional factor of authentication will be implemented. OTP is boring. I mean, OTP is cumbersome. Sometimes network problem is there, so OTP does not come on the phone. So there are issues with OTP. It is not like OTP does not have any issues. Yes, OTP is working satisfactorily, but things can always get better. Understood now? So what RBI wants is, RBI has issued a draft. RBI has issued a draft that alternate authentication, we are working on that. We should have additional factor of authentication, alternate to OTP, and they have invited comments from the people. Now, in this circular, something very important I found, which is the following are exempted from additional factor of authentication. When is it that you don't need OTP? So if you are doing a small value contactless card payment, so up to 5,000 rupees, you can do a transaction from your card, right? And you don't need OTP, right? You don't need OTP if you are doing a transaction, small value contactless card payment, right? You don't need additional factor of authentication, whether it is a PIN or you don't need. So for example, I when I go to petrol pumps, I always make sure that even around 6,000, up to 6,000 rupees, I can take petrol. It's I think a 80 liter engine, 80 liter petrol tank in my car. But I tell him to put 5,000, because 5,000 I will be able to just tap my card and I don't need to enter the PIN. Very convenient, no? So up to 5,000 rupees, if you are paying by card or by anything, you don't need to put in an additional factor of authentication, whether it is a PIN or a OTP, or you don't need it, right? That is number one. In fact, there are now wearable devices like a ring and all these things have come. So you can just tap, or even watches have come. You can just bring your watch near a point of sale machine and you can make a transaction, but again up to 5,000 only, because it is contactless card payment, small value. Then e-mandate. E-mandate is what? For example, if you have taken a Netflix subscription, it is around 700 rupees, I think. So the 700, you can put an e-mandate and you don't need an additional factor of authentication. The money will be auto debited from your account, right? But what if Netflix was 16,000 rupees per month? Just to make you understand. Could you still do it? No. So remember that the limit for e-mandate without, I repeat, without additional factor of authentication, you can do e-mandate for values up to 15,000. However, if you are making a credit card bill payment, or if you are making a mutual fund SIP every month, systematic investment plan SIP, you are putting money into the mutual fund, or if you are paying your insurance premium every month, then up to 1 lakh rupees you can enable e-mandate and you don't need additional factor of authentication. So for example, let's say if I am on every first of every month, I need to invest 70,000 rupees in my mutual fund. Can I do that? Can I enable SIP? Yes. Yes, I can. 70,000 is possible because it is less than 1 lakh. So if you are investing in mutual fund on first of every month or any date of every month, for ultimately e-mandate, there will be a day when money will be auto debited from your account. Similarly, if you are paying insurance premium on first of every month or any day of every month, or you are making credit card bill payment and you want to set a automatic payment every month, e-mandate, you can do it up to 1 lakh. For only these three things, you can do a e-mandate up to 1 lakh without additional factor of authentication. But for all the other purposes, apart from these three, the limit is up to 15,000. Now, you don't need AFA, additional factor of authentication, whether it is a PIN or OTP, if you are using a mass transit service or a gift PPI, or if you are making a transaction in the National Electronic Toll Collection, for example, FASTag. Now, FASTag, do you need OTP? No, you don't. You don't, because it is a part of the National Electronic Toll Collection. For FASTag, you don't need. Similarly, for your Metro card, you must have traveled by Delhi Metro or some metro. Do you need for your Metro card the OTP or PIN? No, you don't, because it forms a part of mass transit service. So if you have bought Amazon voucher of 10,000 rupees and you have gifted it to your friend, does your friend need AFA for that, OTP or anything like that? No. So for gift PPI also, you don't need. These are exempt from additional factor of authentication. Similarly, if you are making a small value digital payment in the offline mode, so offline payment transaction up to 500 rupees only, they are also exempt from additional factor of authentication. So this was said in the circular. And now let me tell you about the interest rate on the small savings schemes. You can see the circular. It came on 28th of June 2024. And there is no change, basically unchanged. Unchanged is what they said. So from July to September, July, August and September, these 3 months, this quarter, the interest rate on the small savings schemes will not change at all. So the old rates will remain. Now, out of all these, you need not remember all, just remember for these 5. In fact, monthly income account scheme also you don't need to remember. So just remember these 5. That's it. That's all you need to remember. So what is that? Let's start with the senior citizen saving scheme. Senior citizen saving scheme maturity period is 5 years, right? Maximum investment possible is 30 lakh rupees. You can invest maximum 30 lakh rupees in a senior citizen saving scheme and you will get, look at this 8.2. That's a very healthy interest rate that you will get. 8.2 assured interest rate you will get. What is the minimum investment in senior citizen saving scheme? Just 1,000. Maximum is 30 lakh. Maturity period is 5 years. And you will get 8.2% till 30th of September. 30th of September, right? National Saving Certificate. Another very important National Saving Certificate is a very important small saving scheme instrument, right? So National Saving Certificate, again, maturity period is 5 years. Minimum investment is 1,000 rupees. 1,000, that's it. Only 1,000 is minimum. Maximum, there is no limit. Maximum, there is no limit. And 7.7% is the interest rate that you will get. Now, Public Provident Fund maturity period is 15 years. 7.1% you will get. Minimum investment is as low as 500 rupees and maximum is 1.5 lakh rupees in one financial year. Then you have Kisan Vikas Patra. Kisan Vikas Patra, the interest that you will get is 7.5%. Kisan Vikas Patra, let me tell you, the maturity period is not fixed. Why? Because the money doubles on maturity. So whenever your money doubles is your maturity period. So here the money will double in 115 months. So you can say the maturity period is 115 months. In Kisan Vikas Patra, money doubles on maturity. So if, for example, the interest rate tomorrow becomes 7.6, then the maturity period will decrease because the money will double much faster. Like that. And then Kisan Vikas Patra, what is the minimum investment? 1000 rupees. Maximum, there is no limit. And then you have, of course, the Great Sukanya Samriddhi account. Maturity period is 21 years. And Sukanya Samriddhi account, you can invest as low as 250 rupees and maximum investment is 1.5 lakh rupees in one financial year. So the interest rates, they have not changed for the small savings scheme. Very important. Now, Reserve Bank of India has appointed two people as executive director. One is Arnab Kumar Chaudhary. And I will tell you more about the executive director in this video only in a bit. So executive director basically is the third highest position in the RBI. First is, of course, the governor of the RBI, Shaktikant Das, and then you have the 4 deputy governor. So the number of deputy governors cannot be more than 4. And third highest position is the executive director. Now, Reserve Bank of India and the ASEAN countries, they are creating a platform to facilitate instantaneous cross-border retail payments. This is a circular that came on the first day of July. Reserve Bank of India and the ASEAN countries, they are creating a platform. And what is this project called? This is called Project Nexus. It is called Project Nexus. So which are these ASEAN countries that are a part of it? So basically, there are fast payment systems, right? What is India's fast payment system? UPI. Similarly, other countries also have their own fast payment system. Now, for example, let's say if you want to send money to Malaysia, can you send through UPI? Obviously, you can't. But let's say if Malaysia has a fast payment system and India has a fast payment system, if we integrate the two on a platform, then is it possible? Yes. So that is what we are trying to do. Now, there is a bank called Bank for International Settlement, which is headquartered in Basel city of Switzerland. And that is why these are called Basel norms, you know. So Basel is a city in Switzerland. So Bank for International Settlement, it is the brain of Bank for International Settlement. It approached these countries and India. So how many countries are a part of this? How many ASEAN countries? 4. Which are those 4 countries? So these are Malaysia, Philippines, Singapore and Thailand. Malaysia, Philippines, Singapore and Thailand. So Malaysia, Singapore, Philippines and Thailand. Don't forget the names, extremely important. And you have the Reserve Bank of India from India and you have the Bank for International Settlement. So these are launching the Project Nexus. So Project Nexus will go live in 2026 and it is a platform where the fast payment system of these 5 countries, India, Malaysia, Philippines, Singapore and Thailand, will be connected together. On one platform so that the fast payments become integrated, interoperational, and yeah, that is what it will happen. And Indonesia is not a part of it, but Indonesia, the Central Bank of Indonesia, it was an observer. So maybe in future they will integrate Indonesia also. For now, Indonesia is not a part of it. Only Malaysia, Philippines, Singapore and Thailand, but Indonesia is an observer. So maybe in future, Indonesia will also be there. Now there are 70 countries today in the world where domestic payments reach their destination in seconds at near zero cost to the sender or recipient. For example, UPI is free. So this is thanks to the growing availability of instant payment system. India has UPI. Similarly, 70 countries, they have some sort of domestic payment system. But the greatness is that if we connect these instant payment system to each other, then we can even do cross-border payment within seconds, according to the Bank for International Settlement. So Bank for International Settlement is bringing countries together now. Now, what will be the fight? The fight will be, like for example, we are trying to popularize UPI abroad. We are trying to popularize the UPI abroad. And if every country starts popularizing its own IPS, that will be a problem. So some countries may feel threatened by this idea that all the instant payment system, they will be connected to each other, because that would mean a less globalization of their own instant payment system. So what are the benefits of Project Nexus? So Project Nexus is designed to standardize the way instant payment systems, they connect to each other, right? Rather than a payment system operator building custom connections for every new user, they are basically put on one platform. That's it. And where did this idea come from? It came from Eurosystem. What is Eurosystem? So Eurosystem has the European Central Bank and the national central banks of those countries that have adopted the euro. So in the European Union country, the euro country, the countries where, so there are countries in European Union where euro is not the currency, but in those countries of the European Union where euro is the currency, the eurozone country, we call them eurozone. So in the eurozone country, powered by European Central Bank, they use Eurosystem. So Eurosystem is a very potent, very potent, very very good, very innovative, fast payment system. Okay, so this idea came from Eurosystem. And Eurosystem, what it is called? Target instant payment settlement. So Eurosystem basically has European Central Bank and the Eurozone country. And what is the name? So for example, in India, the fast payment system, the instant payment system, whatever word you want to use, is UPI. Similarly, in Eurosystem, what do they use? They use TIPS, or Target Instant Payment Settlement. They use TIPS or that. Similarly, in Malaysia, they call it RPP. In Singapore, they call it FAST, or Fast and Secure Transfer Payment System. I mean, they're different names. Singapore also has another system which is called Pay Now. So it depends. It really depends. So then in November 2022, the talk started gaining momentum, and finally we are in 2024. Project Nexus is signed, sealed, and by 2026, Project Nexus platform will become live. Now let us talk about a circular from 1st of July, which talks about the rate of interest on the floating rate saving bonds. And these are the floating rate saving bonds. Basically, the interest rate for almost 6 months has been announced by the government of India, right? These are called floating rate saving bonds 2020. Now for these, the interest rate is the interest rate on National Savings Certificate plus 35 basis points. So National Savings Certificate, what is the interest rate? 7.7%, and you add 0.35, that is 35 basis points. So it become 8.05. So it is not changed. Even in the last 6 months also it was 8.05, and now also it is 8.05. And I was telling to you about the hierarchy in the RBI, where I told you the new executive director. So this is the hierarchy. Now when you clear RBI Grade B exam, you become assistant manager, and then you rise in the ranks. Look, some rise you will get by just your duration, but after a point you will be promoted, based on the talent, So it is not uncommon to see that RBI Grade B people, they join here and then they become manager, then like that they keep on going, and they can go as high as the governor. So executive director, I told you, it is the third highest position after governor and deputy governor. So Charulata Kar has become the new executive director. Her tenure started from 1st of July. And one more name I told you earlier. So there are multiple executive directors in the RBI. Now John C. Williams, he was the chief guest for delivering the 4th Suresh Tendulkar Memorial Lecture. So these lectures are in the memory of the great economist Suresh Tendulkar, and the title of the lecture was Managing the Known Unknowns. This lecture is available on the RBI website. I read the lecture, but I did not find anything in the lecture that the examiner can ask you the question from. So Suresh Tendulkar, he was an Indian economist, and he was the former chief of the National Statistical Commission. He was also a member of the Prime Minister Manmohan Singh's Economic Advisory Council from 2004 to 2008. And he was also the chairman of the Prime Minister's Economic Advisory Council from 2008 to 2009. Now, the most significant contribution of Suresh Tendulkar was he gave a figure that determined the poverty line. So if you earn less than that, you are below the poverty line. So Suresh Tendulkar Committee was set up by the government of India for studying the Indian population, and then devising or demarking a poverty line so that we can get to know how many people in India are below that and therefore below the poverty line. Now, Reserve Bank of India has put monetary penalty on Punjab National Bank. And as I told to you in my last video also, that RBI puts penalty on a lot of banks or a lot of financial institutions, NBFCs, cooperative banks. But if it is a large bank, it can be asked in the exam. So how much is the penalty on the Punjab National Bank? So the penalty is 1 crore 31 lakh 80,000. 1 crore 31 lakh and 80,000 rupees. And why this penalty was put? This penalty was put because Punjab National Bank was not following rules and regulation with respect to loans and advances, statutory and other restriction, and also the KYC was not proper. KYC was not proper. That is why. So what was Punjab National Bank doing? Well, Punjab National Bank sanctioned the working capital. Working capital here means loan. So working capital demand loan to 2 state government owned corporations against the amounts received from government, receivable from government by way of subsidy, refund, reimbursement. It is a violation of the direction. What is the meaning of this? So let's say I am a housewife. Okay, I am a housewife. Now I go to Punjab National Bank and I tell them, look, I am from Jharkhand. Okay, now Jharkhand government has started a scheme, Pradhan Mantri Maiya Samman Yojana, where I am eligible for getting 1,000 rupees per month. Okay. So therefore, in the next 12 months, I will get 12,000 rupees from the government of Jharkhand. Against this, can you give me loan? Because you know that I will be getting 12,000 per month. Can Punjab National Bank give the loan against this 12,000, which will come in the next 1 year? No. No. Any bank in India is not allowed by the RBI to give loans, give working capital demand loans against the subsidy, against any kind of receivable in the form of subsidy. You cannot do that. It is not allowed by the RBI. And of course, Punjab National Bank suffered heavily because of that, and very fairly penalty of more than 1 crore rupees was put, right? So where you cannot give subsidy against what? Well, you cannot give subsidy against any receivable, right? Amount receivable from if you are getting a amount from a government by way of refund or subsidy or reimbursement, you cannot take loan against that. It is a violation. But PNB is PNB. They were not following the rule and regulation. Now let's talk about the KLEMS database. This is a circular from 8th of July, my birthday. So Reserve Bank of India placed on its website an update on KLEMS database. What is KLEMS database? So basically they analyzed from 1980-81 to 2023 the productivity for 27 industries, right? So this is called the KLEMS data and it is updated every year, right? So what is KLEMS? K stands for capital, L stands for labor. The full form is very important from exam point of view. It can be asked in the interviews also. E stands for energy, M stands for material, and S stands for services. So KLEMS database, and 27 different industries that were covered for this period, 1980-81, so 32-33 years data. And this data is very helpful because it tells you about the productivity of India's industries. So it tells you about the productivity. This industry-wise estimate, it is an estimate of industry-wise productivity. Different industrial sectors are there in India and we get to know the productivity of all of them through the KLEMS database. So what all the things came out in this? So for example, one thing that comes out in this is the employment. So if you talk about the employment, then in 2022-23 financial year, 59.67 crore people in India, they were employed. Okay. And when the financial year 24 ended, that is 2023-24, 64.33 crore people, they had employment in India. So the number, if you calculate, increased by 4.67 crore in just 1 year. In just 1 year. And India's employment rate increased by 6%, roughly 6%, if you compare from 2022-23 to 2023-24. So India's employment rate increased by 6% in which year? In the financial year 24, and 4.67 crore people got more employment compared to the previous financial year. Now this database, as I said, covered 27 different types of industries. So we get to know the agriculture productivity, we get to know the manufacturing sector, services sector, we get to know the other sectors. So total 27 industries, we get to know the productivity. Now RBI on 5th of July has launched the quarterly survey called Obicus survey. Obicus survey RBI is doing every quarterly basis since 2008. So in 2008, and what is Obicus? The full form you should know of Obicus. So what is the full form? Obicus. Obicus is order books, inventories, and capacity utilization, and it gives you a lot of data, right? So RBI surveys a lot of industries. Look, this is done only for the manufacturing sector. This is a good MCQ. Obicus survey is done for which sector? Manufacturing sector. For example, if the order books are very large, which means what? Which means the companies are getting a lot of orders. Economy is doing well. They are getting good orders, right? Order books. Inventory. Inventory is the goods that you have stored in your godown, in your warehouse. If the inventory is very high, which means the goods are not getting sold. Goods are not getting sold. The economy is in a downflux, right? Inventory. And you will suffer a lot of cost also, inventory cost. You will have to pay warehouse cost and all these things. Capacity utilization. So for example, if you have a shoes company, you can manufacture 1000 shoes daily, but you are manufacturing only 200. It shows what? It shows that you are not getting good amount of order. That is why your capacity, you are operating at just 20% of your capacity. You can manufacture 1000 shoes, but you are manufacturing only 200 shoes. But it also shows that there is a lot of scope for giving new jobs, right? Because if the demand improves, then you can employ more people, because now you are manufacturing 200 shoes, but later on you will need to manufacture 500 shoes, 700, 900. You will need to employ people. If, for example, you can manufacture 1000 shoes and you are manufacturing 1000 shoes, which means you are running at 100% of your capacity, but it is a negative sign that employment generation will not be there, because even if you get good orders, you are almost at, you are already at 100%. So you cannot employ more people now. I'm just giving you one example, I'm just giving you one example of the complex data that you get in the Obicus survey. Now let's talk about Financial Inclusion Index for March 2024. Financial Inclusion Index, so just remember, it is now 64.2. In March 2023, the last financial year, when financial year 23 ended, it was 60.1. So this shows that the financial inclusion has improved in India. The score is between 0 to 100. 100, we need to reach the score of 100. 100 will show complete financial inclusion, and 0 shows complete financial exclusion or zero financial inclusion. So, for March, for every year ends on 31st of March, it takes for 5 months, and then in August every year, the financial inclusion index comes. Okay, the financial inclusion index comes. Now, financial inclusion index is made up of 3 parameters, 3 broad parameter: access to digital services, access to digital payments, etc. So the weightage is 35%. Usage is 45%. So the maximum weightage is of usage 45%. And then we have quality. The weightage is 20%. Also, there are 97 indicators. There are 3 parameters, but total 97 indicators are there. And in Financial Inclusion Index, you don't have any base year. You don't have any base year. And as I said, the Financial Inclusion Index is published somewhere around July or August, somewhere around that. Now you can see it was published in July, but it can be published in August also. Usually it is published in July, August, that time. And it is published for the previous financial year. So now it was published in July 2024. So currently this is the financial year 25, and it was published for the financial year 24. Now let's talk about, so you can see the first time I have included this very old circular from 2021. This is the first time that Financial Inclusion Index was published, because it was in the monetary policy of 7th of April 2021 that RBI said that we should have a Financial Inclusion Index, and it was published that year for the first time. Anyways, now there are a lot of these research papers that RBI publishes from time to time, and those are not very important from exam point of view, but this research paper I found very interesting. It is estimating the financial wealth of the Indian households. Now, if you see the Indian household, there would be at least 20 crore Indian houses, household. One house may have 5 people, 6 people, like that. So our population is 140 crore, but there will be at least 20 crore households in India. So at the end of the March 2023, so when the financial year 23 ended, I repeat, when the financial year 23 ended, what was the assets of our household? So the household's financial assets were 135% of India's GDP. 135% of India's GDP. What were the liabilities of the households? It was 37.8% of the GDP. So what is the net assets, net financial wealth of India? Net financial wealth, you subtract the liabilities from the assets. So 135 minus 37.8, and what you get is this 97.2% of our GDP. So India's net financial wealth is how much? 97.2% of the GDP. Understood? Okay, now let's talk about Financial Action Task Force. They have taken certain decisions. What are the decisions? So for that, you need to understand what is FATF, what does it do, and what is the circular about India. Okay, so there is a circular about India and there is a general circular. So both I will cover. First of all, what is Financial Action Task Force? See, Financial Action Task Force is an organization, right? It is an intergovernmental organization, which intergovernmental means multiple countries are a member of FATF. India was the 34th country to become a member of FATF, right? And India joined FATF first as an observer in 2006, and then India became a full-time member. Okay, so how many members are there of FATF currently? There are 40 members. Which is the 40th country to become member of FATF? It was in October 2023, very recent. It is Indonesia. Indonesia is the latest member of FATF. It is the 40th member of FATF. FATF for a long time had 39 members. In fact, the data is not updated on most of the websites, but on the official website, it is updated now, finally, after almost 1 year. We are moving towards October 2024. So Indonesia is the 40th and the latest member of FATF. And FATF is headquartered in the capital of France, which is Paris, where recently Olympic Games have taken place. So FATF checks money laundering. The money should not be used for terrorism, money laundering especially. So it basically recognizes the efforts that the member countries of FATF they do towards stopping the money laundering and anti-terror activities. So there was an evaluation. There is an evaluation that is done for all the members by FATF every year. So FATF, they had evaluation recently. Their session happened in Singapore, and with respect to India, India received an outstanding outcome in the evaluation. FATF is extremely satisfied by the efforts that India has taken to stop money laundering and terrorism financing. So India has been placed in which category? Regular follow-up. Regular follow-up. Now look, there are 4 categories of FATF. Okay, there are 4 categories of FATF. One is called regular follow-up. Let me tell you the categories. One is called regular follow-up, and FATF was set up in 1989. India became an observer of FATF in 2006, but India became a full-time member of FATF in 2010. So these are the 4 categories. One is regular follow-up. Regular follow-up means it is the best category. So FATF is very happy with you. Whatever you are doing, it is very happy with you. I mean, you are doing good work. You are preventing money laundering. You are preventing terrorism financing. Extremely satisfied, right? Now, India has been put in regular follow-up category. This is the best category, right? In fact, in this category, we have Russia, France, Italy, UK. Some of the top countries are in this category, right? So what is the advantage that India will have? Well, India does not need to do any follow-up now till October 2027. We are in 2024 now. So for next 3 years, we don't have to submit a progress report. So we have to submit a progress report in after 3 years. This shows how happy FATF is with India. Now, which are the other categories? So we have a regular follow-up. This is the best category. The second best category is the enhanced follow-up. Enhanced follow-up means that, look, nothing to worry as such, but things can be better. So we will need regular monitoring. We will need enhanced follow-up with you. The third best category or the second worst category is the gray list. If you are in gray list, then yes, it is problematic. I mean, FATF is not exactly too pleased with you. And the worst is the blacklist. If you are blacklisted by FATF, then no country will give you loan. No organization like World Bank, or they will give you loan, it will be extremely difficult for you to do business with anyone. For example, which are the blacklisted countries? So I will tell you. And as I said earlier also, 40th member of FATF is Indonesia. And this you can see is the official website, fatf.com. So which are the countries which are blacklisted by FATF as of latest June 2024? It is North Korea. DPRK means Democratic People's Republic of Korea. This is the other name for North Korea. Iran is blacklisted and Myanmar is blacklisted. Now grey list, again, no country would want to be in the grey list because it is the second worst. So we have countries like Bulgaria, Burkina Faso, Cameroon, Democratic Republic of Congo, Haiti, and all these countries like Namibia, Mozambique, and Senegal, and all these countries are in the grey list. And then we have, so recently there was a session, let me tell you about that. So in this session, what happened? Well, they said that the jurisdiction that are put under increased monitoring, which are those? So these are Bulgaria, Burkina Faso, and I mean there are a host of countries. But when this session happened in Singapore, it was decided that Monaco and Venezuela, they have been added to those countries which need increased monitoring. But Jamaica and Turkey, they have been removed from the list. So Jamaica and Turkey, they were removed from the enhanced monitoring list, and two countries were put in the list, Monaco and Venezuela. So that is what is being said. And otherwise, Myanmar is blacklisted, and all the three countries, North Korea. So the list remains. No country has been put outside of the blacklist. So the blacklist remains unchanged. Blacklist remains unchanged, right? Okay. So that's all you need to know with respect to FATF. Now let's talk about a very, very important circular that came on 15th of July 2024. And these are the master directions of the RBI on fraud risk management in the regulated entities. Regulated entities means what? NBFCs and banks, and AIFI, All India Finance Institution, Cooperative Bank, basically whatever is regulated by the entity, regulated by the RBI. Regulated entity means that. So the fraud risk management, because see, the frauds are very common, right? Frauds are extremely common. And these fraud risk management guidelines are also now applicable to regional rural banks, rural cooperative banks, and housing finance companies also. Housing finance companies also, so that there is a better fraud risk management and there is a better fraud risk framework. Look, these guidelines are very, very massive. But first, let me tell you about 10 types of frauds that RBI says, because you should know what are the types of fraud that people do. So these are the 10 types of fraud that RBI has said. What are the fraud? So for example, misappropriation of funds and criminal breach of trust, fraudulent encashment through forged instruments. You are making fake bills to encash money, manipulation of books of accounts, etc. Cheating by concealment of facts when you don't disclose facts. Forgery with the intention to commit fraud when you forge any document. Electronic records, false documents. Willful falsification, destruction, alteration, mutilation of any book, electronic record, paper, writing, etc. Fraudulent credit facilities, cash shortage on account of frauds, fraudulent transaction involving foreign exchange, and fraudulent electronic banking, digital payment related transaction committed on the bank. So all of these are the frauds. Okay, so there are 10 types of frauds. There are 10 type of frauds. Now what happens if there is a fraud? So basically the banks, the NBFCs and all, they give in writing to the RBI. This is called fraud monitoring return. See, just like you file your income tax return, similarly banks also have to file fraud monitoring return. Well, they will tell everything to the RBI, but more on that later. Let me just go step by step. So let me now come to, first of all, the fraud. So what changes for the banks now? So these are master guidelines on fraud risk management. See, every bank or every regulated entity, if it is into the business of giving a loan, it now has to have two things. First, it should have a data analytics unit and it should have a market intelligence unit. Why? Because if it has a data analytics unit and market intelligence unit, then better risk management will take place. It is now compulsory, it is now mandatory for a bank to have a data analytics unit and a market intelligence unit. Okay, otherwise RBI will not be happy with you and strict action will be taken against you. So what will this data analytics unit and market intelligence unit help in? It will help in early warning signal. So, lot of accounts before they become NPA, or, if they commit any fraud, there are always this signal. These are called early warning signal, which you have to identify. You can red flag the account. Red flag means you do increased monitoring. You keep those accounts separate so that you can watch them, you can do surveillance of them. And you have to timely report it to the law enforcement agency. How do you report that? I will come to in a bit. This you have understood. So the first thing that you need to remember in the fraud risk management is that every Bank of India now has to have a data analytics unit and a market intelligence unit. So there was a Supreme Court judgment also, right? State Bank of India and ORS and others, OR means others, versus Rajesh Agarwal and others. So this is a landmark Supreme Court judgment that came in 2023. And what does it say? So let's say there is a bank, there is a State Bank of India. It has identified an account as a fraud. There is some fraud happening. Can it start penalizing it? No. First, the principle of natural justice has to follow. What is the principle of natural justice? And this is a big change which has happened in this new circular. You give the, so see, every person, every account owner, he has the right to respond. So the defaulter should be heard. He has the right to be heard. This is called principle of natural justice. Okay. So banks can't unilaterally declare an account as fraud. If SBI notices that, look, there is some account which is fraud, it cannot declare it as a fraud unless you give the person a right to reply. So if you think some person is defaulter, if he is at fault, you give him a chance to explain himself. Please give him a chance to explain himself. And how much chance you have to give? 21 days time you give. Very important MCQ. So the banks in India, they have to give a time of 21 days to the potential defaulter or so-called defaulter, or suspicion, if there is any suspicion of a defaulter. You give him a chance to reply. This is called right to reply, right to be heard, principle of natural justice. You ask him, you give him a time of 21 days to respond. Understood or not understood? Now, let's say there is a regional rural bank. You know that now even these fraud risk management directions are applicable to regional rural bank and housing finance companies and all. So regional rural bank, if there is any fraud that is happening, it will report it to NABARD. See, regional rural banks, it is supervised by NABARD, but it is regulated by the RBI. Nonetheless, regional rural banks will report the incidents of fraud to NABARD as hitherto. Hitherto means so far. So as was happening till now will continue. RRBs will report the incidents of fraud to whom? To NABARD. Now, the board of directors for domestic banks and local advisory board in case of foreign banks operating in India. So, if there is a domestic bank and there is a fraud happening, then whom it will be reported to? First, it will be reported to the board of directors. It will be reported to the board of directors of the bank, and then board of directors will report it to the RBI and all that. I will come to it later. Let's go step by step. What about the foreign banks? If there is a foreign bank like Citibank or DBS Bank India, DBS is originally a bank from Singapore, but DBS Bank, if there is a fraud, whom they will report to? So they will report it to the local advisory board. So the foreign banks who are operating in India, the foreign banks which are operating in India, they also have an advisory board which is called local advisory board. So they will report it to that. Now, this table is very important. So if there is a domestic bank, let's say you are sitting on a cashier. Okay, you are a cashier in a bank and some fraud is happening somewhere. Okay, so whom will you report to? You will not go to the law enforcement agency. You will report to your manager, and your manager will report it to his senior. Finally, the fraud has to be reported to the board of director. That is what it is written. For domestic bank, you report it to the board of director. Board of director means what? It will have the managing director, CEO, the non-executive chairman of the bank, the executive chairman of the bank. All these big people will be there. So now the problem has reached to the top person in the bank. But then what happens? So then they will report the fraud to the law enforcement agency. LEA means what? Law enforcement agency. So if it is a private sector bank or if it is a foreign bank operating in India, okay, which is the law enforcement agency to whom the complaint should be lodged. So if the fraud is less than 1 crore, they will lodge the complaint with the state or the union territory police in which they are present, in which which is the jurisdiction. Okay, so if the bank is in Gurugram, they will report it to the Haryana police, the Gurgaon local police, right? If it is a bank in Puducherry, they will report it to the Puducherry police. If it is a Delhi bank, then the Delhi branch, some fraud has happened, then they will report it to Delhi police. So I repeat once more. If it is a private sector bank or a foreign bank operating in India, any private bank like ICICI Bank or HDFC, if the fraud is less than 1 crore, they will report it to the local police, the state police or the union territory police in which they are present. But if the fraud is more than 1 crore or above, if the fraud is 1 crore or more, then so in addition to the state or union territory police, they will also report it to the Serious Fraud Investigation Office. And let me tell you, Serious Fraud Investigation Office works under the Ministry of Corporate Affairs, Government of India. Now let us talk about the public sector banks and regional rural banks. So public sector banks and the regional rural bank, if they notice a fraud, okay. Now look, if the fraud is less than 6 crore, they will report it to the state or the union territory police. But here is the thing. If the fraud is 6 crore or more, then the public sector banks and RRBs, they will report it to the CBI, Central Bureau of Investigation. So these are the law enforcement agencies which you have to report to. This can come as a MCQ. Now let's come to the steps. Okay. So when the complaint reaches the board, okay, they have to report to the law enforcement agency, all that is fine. Now what should the board do? So every board of director, they should have an approved policy on the fraud risk management. Every bank's board of director should have a policy, right? And properly demarcated. And see, the board member should have proper responsibilities also. So the responsibility of the board and board committee and senior management should be there. For example, if the board of director, there are 10 people in the board of director, there should be responsibility fixed to a person that look, if something like this happens, then what has to be there. And as I said, the policy should also incorporate principles of natural justice in a time-bound manner. So what is that principle of natural justice? You give the person or the company to which the show cause notice. So first of all, you issue a show cause notice. For example, there is an account in the name of Vishal Sharma. Okay, Vishal Sharma, and I am a manager and I see, look, this is looking a fraud. Now, do I immediately declare it as a fraud and go to the law enforcement agency? No, I don't. What do? I tell him to show up. I ask him to meet me. So I will issue what? Show cause notice. Show cause notice. And how much is the time? 21 days should be provided to him. Reasonable time, not less than 21 days. Okay. So the time period you give him, not less than 21 days, you ask him to respond to the show cause notice, which means he will come to you and then you ask him tough questions. What the hell is going on and all those things you ask him. Now, banks, they should also make a committee which will be known as SCBMF or Special Committee of the Board for Monitoring and Follow-up of the Cases of Frauds. So there should be a special committee and that committee should have a minimum of 3 members of the board. It should have a whole-time director and minimum of 2 independent director or non-executive director. The committee shall be headed by one of the independent director or non-executive director. I repeat, there should be a committee in every bank. Okay, that committee should have minimum 3 members. Okay, and all the 3 members should come from the board of director. So whole-time director has to be there, whole-time director, and a minimum of 2 independent director or non-executive director. And the committee will be headed by an independent director or a non-executive director. So then this committee will look into the fraud risk management of the bank. It will review and monitor the cases of the fraud, do the analysis of the fraud, why the fraud happened, and try to control, try to have a risk management framework and blah blah, all those things it will do. Now, always look for the early warning signal. See, even the smartest of person will give you some signal that something is wrong somewhere. Okay, develop an intuition. So identify the early warning signal. Do the red flagging of the account. Red flagging simply means you mark those accounts as different, right? Red flag them so that you can have enhanced oversight. You can have enhanced surveillance. right? By whom? By the board. There will be a risk management committee of the board. That risk management committee will tell the framework for early warning signal and red flagging of the account. So what are the early warning signal? How to identify them, So all these framework has to be made by the risk management committee of the board. So risk management committee, I told you red flagging of the account and EWS, early warning signal. So they will do all these things. They will, for example, they will initiate remedial action on alerts or trigger from early warning system in a timely manner. If there are any early warning signal, you help in solving that problem, do the periodic review. And this is very important. Effective use of central repository of information on large credit. So there is something called central repository of information on large credit and central fraud registry. So these are two registry. First of all, every bank in India, whether it is SBI or a private bank or whatever, if somebody has taken very large loans, like for example, some company has taken 1000 crore loan from SBI, you report it to CRLIC. What is CRLIC? It is called Central Repository of Information on Large Credit. So somebody has taken large credit, you inform. And if there is a fraud, then you report it to the Central Fraud Registry. All of this work will be done only when you follow a proper process. Okay, when you follow a proper process. And as I told you earlier also, every bank will set up a data analytics and market intelligence unit that will also help them to identify the early warning signals. The early warning signals, right? Now, if there is an account which meets the CRLIC reporting threshold, once red flagged, shall be reported to the RBI within 7 days of being red flagged. So let's say there is any account in the name of Vishal Sharma and you are noticing some fraud happening there, okay? And the CRILC, to report to CRILC, there are some criteria. And this account is fulfilling those criteria. Okay, so you have already red flagged the account, you have identified the early warning signal. Now what you do within 7 days, you report that account to CRILC of the RBI. So once an account meets the CRILC reporting threshold, within 7 days, you report it to the Reserve Bank of India. By the way, the CRILC, the Central Repository on Information on Large Credit, and Central Fraud Registry, they are not applicable to the RRBs. They are not applicable to regional rural banks. Also, aggregate fund-based and non-fund-based exposure of 3 crore and above for reporting the red flagged account or fraud. Basically, large credit, So the fund-based and non-fund-based exposure should be at least 3 crore and more. Only then it should be reported to the CRILC because it is only for the large credit. If somebody has taken a loan of 20,000 crore, you don't report it to CRILC. You only report when the fund-based and non-fund-based exposure is 3 crore and more. Is that clear? First of all, understand the difference between fund-based and non-fund-based exposure. See, if you go to a bank and you ask for a loan of 5 crore rupees and the bank gives you the loan, that is a fund-based exposure. So bank has actually given you the amount, that is fund-based exposure. Fund-based, they have given you the fund, no. But let's say you are doing import-export. You are in the business of import-export. This is you. And you are selling steel. You are selling steel wires abroad. Okay, you are selling steel wires abroad. Now you have sold steel wires abroad worth 5 crore. And there is this exporter abroad. So you want to take a bank guarantee. This person is giving you a bank guarantee that if I don't pay the money, please send me the steel wire worth 5 crore. If I don't pay, the bank is taking guarantee. So, okay, HDFC Bank is taking the guarantee. If this person does not pay, I will pay. So this is a non-fund based exposure. See, HDFC has blocked 5 crore here. Yes, this money is not given to you, but they will give you in case something happens. But in any case, they have to keep aside 5 crore, right? Because when you go and collect money from, if some fraud happens, if the person does not give you money, you will go to HDFC Bank and ask for 5 crore. So they should be in a position to give you immediately. Liquidity coverage ratio has to be there, no, 100%. So here also the bank is keeping money aside, but it is a non-fund based exposure. They have not given money to you. They have only taken a guarantee. So what is fund based exposure? Fund-based financing simply means the actual disbursement of the funds from the lender to the borrower. So all the lending like the loan, overdraft facility, cash credit, term loans, all of these are fund-based. So in fund-based financing, the direct flow of money happens into the borrower's account. What is non-fund-based financing? So in non-fund-based financing, the money does not there is no actual disbursement of the fund, but some financial guarantees or commitments are given from the lender to the borrower, from the bank to the borrower. So for example, letter of credit, bank guarantee, performance bonds, etc., etc. These are all non-fund-based exposure. So you report to the CRILC when there is a fund or a non-fund based exposure of 3 crore or more. Now then what happens? So basically the decision to classify any account, either standard or a NP account, as a red flagged account shall be at the individual bank level, and such bank shall report the status of the account on the Reserve Bank CRLIC platform immediately, not later than 7 days, as I told you. There is an account, Vishal Sharma, you have red flagged the account. But I told you, you given the chance to reply in 21 days and all the things I've told you. But within how many days you have to decide whether it is account is a fraud or not a fraud? That decision you have to take, no. So that you have to take within 180 days from the date of first reporting of the account as red flagged on the CRLIC platform. So when you have reported an account on the CRLIC platform of the RBI, after that within 180 days you have to take the decision whether it is a fraud account or not a fraud account. And I told you about the principle of natural justice. It is called the right to be heard, or odi alterum partem. This is a Latin language. So right to be heard. Now let us say that there is a account which has been declared as a fraud by the banks. Then, so to every person who is associated with that account or that company, you ban them from raising further funds, right? Or seeking additional credit facility from any financial entity regulated by the RBI for a period of 5 years from the date of full repayment of the defrauded amount or settlement amount in case it has been agreed upon. So when you have agreed to declare account as a fraud account, then what happens? For next 5 years, every person, every company associated with that account, no loan for next 5 years, no loan for next 5 years, right? And once it is identified as a fraud account, then what do? You put it into the Central Fraud Registry. The Central Fraud Registry. Understood? Central Fraud Registry is a database maintained by the RBI. And what happens? So the fraud related data, including the updates, they directly flow to the CFR from online reporting by the banks through the fraud monitoring return. So fraud monitoring returns the bank have to file from time to time. Now comes the next question. When do the banks have to file the fraud monitoring returns? So the bank shall furnish fraud monitoring return in individual fraud cases, irrespective of the amount involved, immediately, but not later than 14 days. So they should try to report it immediately to the RBI, right? But not later than 14 days from the date of classification of an account as a fraud. When you have declared an account as a fraud, then you have to file a fraud monitoring return immediately, but you can take a time up to 14 days. The best practice is to report immediately, but yes, do it within 14 days. And also the incidents of fraud, I told you, you have to report it to the law enforcement agencies, and the slab I already told you, right? And then the closer you can do, you can approach the court, and you can you can approach the court, you can go SARFAESI route, you can take tribunal route. So those details we will not go in detail, right? But what if there is a theft or a burglary or a dacoity or robbery in a bank? Then what? Well, so the banks will report any theft, burglary, dacoity and robbery, including attempted cases. Even if they are not successful robberies, you still report them to fraud monitoring group, which comes under the Department of Supervision, Central Office of the RBI, right? Immediately. Ideally immediately, but okay, you can take a time, maximum 7 days from their occurrence. Right? So that was what was the circular. It was slightly, I don't think, to be honest, it was that needed to explain in that detail, but I still did it because fraud risk management, it's a tricky issue, right? Fraud risk management. I mean, tomorrow you become bankers, you should also be able to identify the accounts. You should be able to red flag. You should be able to identify the early warning signals. I'm sure you will learn it in training, but okay. Okay, now let's come to another circular that came on 15th of July 2024. Well, actually, this is the same circular. Those guidelines on fraud risk management, uh, the same guidelines they apply to NBFCs, including HFCs also. However, you have to remember that these guidelines will apply to these NBFCs. Now, NBFCs are of four types. They are base layer, middle layer, upper layer, and top layer. So these guidelines, they apply to all the NBFCs and HFCs in the upper layer, middle layer, but the one in the base layer only with the asset size of 500 crore or more. So these guidelines of fraud risk management, they will apply to whom? So they will apply to, so there are four layers of NBFC. So there is the base layer, there is the middle layer, upper layer, and top layer. So they will apply to whom? They will apply to all the NBFCs in the upper layer, middle layer, but in the base layer, they will only apply to those NBFCs which have an asset size of 500 crore or more. Which have an asset size of 500 crore or more. Is it absolutely clear? And that's all you need to know in this. Now let's come to a circular that came on 19th of July. The Reserve Bank of India clarified the impact of an outage in Microsoft services on its regulated entities. So, in July, something very strange happened. What happened? Well, like especially on the airports, like most of the airlines, they are using the Microsoft in their computers. They are using Windows and Microsoft softwares. Similarly, a lot of banks in India, they use Microsoft Windows and everything. So there was an outage. There was an outage that happened in a lot of banks. The critical systems of most banks, they survived, but still the outage affected a lot of regulated entity. So RBI, and there was a lot of panic actually. That is why RBI came up with the circular and said, look, yes, outage happened, but no need to panic as such. Now, first of all, you need to understand why the outage happened. So when you have a Microsoft, you update your Windows time to time, right? You update it. So, they use a tool called CrowdStrike tool, and this can come as an MCQ. CrowdStrike tool is used by the banks or by anyone who is using Windows to update the Windows. And they use the CrowdStrike tool. They update the CrowdStrike tool also. So when they updated the CrowdStrike tool, it malfunctioned and there was an outage. So the outage happened because of the CrowdStrike tool. Basically, CrowdStrike is a software company, right? It provides cybersecurity. It is a cybersecurity company, CrowdStrike. And CrowdStrike, when people updated CrowdStrike tool, then outage happened. It malfunctioned. So the mistake was not technically in Microsoft, but it was in CrowdStrike. CrowdStrike is an American cybersecurity company. Cybersecurity company. Now Microsoft is saying, I have a contract with CrowdStrike, but CrowdStrike malfunctioned. They might go for some other company now. So there is a kind of a tussle going on between Microsoft and CrowdStrike, that because of you, I had to suffer so much, is Microsoft saying to CrowdStrike. Anyways. Now let's come to a penalty that has been put on Muthoot Finance. See, Muthoot Finance is a company that is based in Kerala. Basically, Muthoot Finance is a company that is one of India's largest NBFCs. It is one of the largest NBFCs of India. So Muthoot Finance is a company that is headquartered in Kochi in Kerala. And Mr. George Muthoot and some Muthoot family, it is one of the largest NBFC in India. And therefore, if there is a monetary penalty on it, it becomes a news. And how much was the penalty? Penalty was not much. It was 1,90,000 rupees. But it was for what? It was, they were not following the proper KYC. They were not following the proper KYC rules and regulation as per the provisions of KYC directions of 2016. So the penalty was put on Muthoot Finance Company. And RBI has recently cancelled the license of a bank from Tezpur, Assam. This is the Mahabhairav Cooperative Urban Bank. Mahabhairav Urban Cooperative Bank. The license has been cancelled by the RBI, and this is a bank that is based in Tezpur. Now let's talk about an index from the RBI called RBI Digital Payment Index for the month of March 2024. So this is a circular that came on 26th of July 2024. Digital Payment Index for March 2024. Digital Payment Index. So RBI has been publishing Digital Payment Index since 1st of January 2021. What is the base year? March 2018 is the base year. Look, for Financial Inclusion Index, there was no base year. But for Digital Payment Index, there is a base year, right? And Digital Payment Index, as the name shows, look, March 2018 is the base. So base we take as 100. And then we calculate the progress and look at the progress. So from 100, now the Digital Payment Index has reached, at the end of the financial year 24, it reached 445.5. So look at the growth in the digital payment in India, the adoption of the digital payment in India. India is one of the largest adopters of digital payments, right? So they give the data for every 6 months. So September 2023, it was 418. In just 6 months, it shot up from 418 to 445. 445. This shows the magnificent growth, significant growth in the payment performance and payment infrastructure, both, because this index is made up of 5 factors. So payment enablers, the weightage is 25%. Payment infrastructure, demand side, supply side. So demand side is 10%, supply side is 15%. Payment performance has the maximum weightage of 45% and consumer centricity 5%. So the RBI's digital payment index is made up of 5 broad parameters, and I've told you the individual weightage of all of these parameters. Now let's talk about the liquidity coverage ratio. Liquidity coverage ratio, review of the haircuts on high quality liquid assets and runoff rates on certain categories of deposits. A very, very important circular that came on 25th of July 2024. First of all, you understand all these small terms. What is a haircut? See, haircut is not the haircut that you do every week or maybe every month. That's not haircut. Let's say if I have a bike and I purchase that bike for 1 lakh rupees. Now after 1 year, I am going to sell the bike. Now, if I go and try to sell the bike in the market, will I get 1 lakh rupees or will I get less? I will get less. So let us say I sell the bike for 70,000 rupees. Okay. So what is the haircut I have taken? 30%. 30% haircut. Haircut simply means the less money that you take is the haircut. So 30,000 less I have taken, that 30,000 is my haircut, or 30% haircut I have taken. Understood what is a haircut? Okay. Now let us understand what is a liquidity coverage ratio. See, the bank, they should be able to cover the liquidity demand of the next 1 month. So what the bank has to do? Bank has to do a calculation, and every bank does it, because liquidity coverage ratio has to be 100%. So bank has to do a calculation. What is the calculation? It has to do a calculation that, look, in the next 30 days, how much money will come into the bank and how much money will go out of the bank. Okay, so for example, and I'm giving you a very simplified example, okay, oversimplified example just to make you understand. State Bank of India, and figures also, random figures I will give. So State Bank of India, it does a calculation that, look, next 1 month, 50,000 crore will come into the bank as deposits, and term deposits, and the saving account demand deposits, and the money that will come from RBI and repo rate and all these things. 50,000 will be the inflow. Now 55,000 crore is the outflow, right? So I am short by 5,000 crore in the next 30 days. 50,000 crore will be the inflow, 55 is the outflow, and bank has to do this calculation every month. This 5,000 crore I will have from where? So this will be readily available, right? I cannot say no. See, a bank in India can never say no to a customer if he comes and asks for money, his own deposits. Strict action is taken by the RBI. Bank cannot say no. So usually what banks do, if there is any shortage, what they do is they call other bank, they call money. Have you heard call money? They will call Punjab National Bank branch, please give us some money. All this camaraderie is there between the different managers of the bank. Okay, they help each other. There is an interbank call money rate and all those things are there. But RBI says that you should have high liquidity, high quality liquid assets, HQLA, which means these are very, very high quality assets. that you should make available worth 5,000 crore now. So this can be cash, you know, this can be the money that you have put in cash reserve ratio excess. So for example, cash reserve ratio is 4.5%. If a bank has put 5% in cash reserve ratio, so this 0.5% you can take back, no, from RBI. Cash reserve ratio is the money in cash that the bank has to keep with the RBI. But if the bank is exceeding that, it can always withdraw that. So that is a high quality liquid asset, right? Similarly, SLR, bank has to put 18% money in government securities. What if it has more? It can always withdraw that, right? So high quality liquid assets it has to have and cover for that liquidity that arises. That is called liquidity coverage ratio. So the bank should have 55,000 crore of liquidity outgo. Yes, it will manage 50,000 crore from inflow, but the remaining 5,000 it should cover from high quality liquid assets. Now this circular is about what? This is about the review of the haircut. See, if a bank has cash, it is 100%. If a bank has, for example, 5,000 crore of cash, then immediately it can fulfill its obligation of 5,000 crore, the shortfall. But let's say if a bank has some security which has a haircut. Now look, cash has no haircut. If you have 100 rupees in your pocket, it is 100 rupees only, no. But if you have gold worth 100 rupees in your pocket, and if you convert it into cash, it may not be 100, it will depend. You have to take some haircut. You try and sell this gold. Someone may give you, say, this is gold worth 100 rupee, I will give 95. You need urgent cash, I have only 95. Now you need urgently, okay, you will take 5 rupees haircut, 95, and you will suffer a shortfall. So that is what I am saying. The RBI has reviewed the haircut on high quality liquid assets. Not every high quality liquid asset will give you exact 100%. Some haircut you have to take on some security, right? And also the runoff rates on certain category of deposit. What is runoff rate? See, runoff rate simply means how likely is that deposit to be asked back. For example, let's say there is a bank. Okay. Now two people, they are depositing money. He is coming to the bank physically on foot. You know, old people, they come like physically on foot and deposit money into the bank. And there is a new age generation person who is coming. New age. In fact, he is not even coming to the bank. He is putting the money in FD digitally. Right? Now tell me this. Who is more likely to withdraw the money? This guy. I'm not saying it. RBI is saying it. RBI is saying it. I'm not saying it. RBI is saying this is a digital age. You know, the people who deposit the money digitally, their runoff factor, they want to run away. So their runoff factor is more. A person who is taking all this pain and coming to the bank and depositing the money digitally, he is doing FD, he is less likely to break. Whether he comes in a car or comes on foot doesn't matter. Any person putting money physically is more likely to keep it for longer. But before all of that, let's understand the liquidity coverage ratio. So liquidity coverage ratio is a concept that came after the financial crisis of 2008. In India, Reserve Bank of India implemented the liquidity coverage ratio on 1st of January 2015, right? 1st January 2015. So how do you calculate liquidity coverage ratio? In the next 30 days, in a month, you see the total net cash outflow. Total net word is important. So that is outflow minus inflow. That is becomes your net cash outflow, and you have to match it. So high quality liquid assets. So this is a ratio of high quality liquid assets divided by total net cash outflow. And how much should it be? It should be 100%. It can be more than 100%. The more high quality liquid assets you have, the better it is, right? So every asset that can be easily and instantly converted into cash at a minimum or no cost. Minimum or no cost means at a minimum haircut, right, is a high quality liquid asset. So this is a circular that came on 25th of July 2024. So this is a circular. Basel III framework talks about liquidity coverage ratio. And the HQLA and runoff rate. Runoff rate means the likelihood that a deposit will be withdrawn from the bank. Now look here, the exact thing that I was telling you. The banks, they will have to assign an additional 5% runoff factor for retail deposits which are enabled with internet and mobile banking facility. If you are getting any deposit through a internet or mobile banking, then 5% runoff factor is increased. It's an additional 5% runoff, which means it is more likely to be withdrawn, right? So the deposits are of two types, stable and less stable deposits, which is fine. But if it is a stable deposit or a less stable deposit, in both the cases, if it is by internet banking or mobile banking, you give it a 5% runoff factor more, right? You give it a 5% runoff factor more. So let me show you the table. Now from our interest, only this thing is important. Okay. Let us talk about the deposits in a bank that come. Now, if it's a stable deposit or a less stable deposit, doesn't matter. First, let's talk about a stable deposit. Stable deposit, I mean, as the name says, these are commonsensical terms. Okay, nothing to be explained. So stable deposit, I mean, which are stable, which are less likely to be withdrawn. So the deposits that are coming from mobile banking and all of this. So stable deposit, how much is the runoff factor? 5%. But if it is a deposit coming with IMB, internet or mobile banking, extra 5%, 10% is the runoff factor. I repeat, the runoff factor for a deposit, stable deposit that is coming from internet or mobile banking is 10%. And if it is a normal without IMB, if it is not coming from internet or mobile banking, it is 5%. Now let's talk about less stable deposits. Again, if it is coming from internet and mobile banking or it is not coming from internet mobile banking. So here it is 10 and 15%. So if it is coming from normal route, 10% is the runoff. If it is coming from internet or mobile banking, extra 5%, so 15% is the runoff. 15% is the runoff. And that's all you need to know at your level. So what is a runoff factor? It can be asked as an MCQ. Runoff factor is a measure of the likelihood that deposits may be withdrawn or transferred, including during the times of stress. Now, I told you about the high quality liquid assets, what they could be. So for example, the cash in hand, it is 100%. The excess cash reserve ratio balance, again, if a bank has put in more than required CRR, it can be withdrawn anytime. That is 100%. There is no haircut. 100% they will get, no haircut. Similarly, the government securities in excess of SLR, again 100%, there is no haircut. So like that, there are different types of assets which a bank has. But look here, there is a 15% haircut on these and there is a 50% haircut on this. So you can see the marketable securities representing the claims. I mean, we'll not go into detail, this is a separate topic, but level 2 assets, level 2A and 2B. Now look, these level 1 assets are which have no haircut. 100% they will be converted to cash whenever needed. But then you have level 2 and level 2B assets. So level 2A are taking 15% haircut and level 2B are taking as high as 50% haircut. You can see. Now comes a point which is called margin requirement. What is the meaning of margin requirement? If you go to a bank and you put gold as a collateral, I'm not saying you are going to the market and selling the gold, but if you are going to a bank, you are taking gold loan. What is gold loan? You put gold as collateral and you take loan. That is called a gold loan. So you put gold as collateral, you pledge the gold. The word is pledge. You pledge the gold and you ask the bank for loan. So if you are putting 100 rupee of gold in the bank as collateral, what you will get? Will you get 100 rupee as a loan? No, you will get, let's say, 70. Because gold takes a haircut, no. Bank will not give you, even if gold appreciates over time, bank will still not give you because there is a margin requirement. That margin requirement means what? If you are putting in 100 rupees of gold in a bank as collateral, bank will give you 70 rupees and you pay this back 70 and take your 100. That's okay. So 30% is the margin requirement in this case. Similarly, the securities Like for example, the treasury bills and the central government dated securities, the state development loans, they can be rated or unrated. All of them have a margin requirement. Okay, margin requirement. Now, all of these securities are called what? Unencumbered securities. Unencumbered security. Treasury bills and central development dated security, state development loans and treasury bills, all of these. So what is the margin requirement? Look, the margin requirement will depend on the residual maturity of the collateral. So a bank has high quality liquid asset. A bank can of course take care of its liquidity coverage ratio. However, if a bank wishes to use that as a collateral, then there is a margin requirement. Now, it is very difficult to sell off very long-term maturities. So you can see the residual maturity of the collateral. If it is greater than 15 years, then 4% is the margin requirement in case of a treasury bill and central government dated security. 0.5% for 0 to 1 year, 1 to 5 year residual maturity 1%, 5 to 10 year 2%, 10 to 15 year 3%. State development loan, if it is a rated one, it needs less margin requirement, but if it is unrated, there is more margin requirement. State development loans are also, they can be encashed, no doubt, but there is a margin requirement. So 2.5% for 0 to 1, etc., etc. So this table shows that there is a margin requirement. See, margin requirement is a mandate by the RBI. The difference between the value of a loan and the value of the security is what we call the margin requirement. So value of the security that you are putting gold is 100, but the value of the loan that you are taking is 70. So 30% is the margin requirement. 30% is the margin requirement. So there is a margin requirement for treasury bill. There is a margin requirement for central government dated security. There is a margin requirement for state development loans. Why I am telling you this is because you need high quality liquid assets, right? So if you have invested in government securities, you can put those government securities as a collateral. If there is a bank, State Bank of India, if it is having some shortfall of money, right? So to cover the liquidity coverage ratio, either it can sell the security, but it can also put this government security as a collateral and take money. But then there will be a margin requirement. There will be a margin requirement that they have to see. So all these complex calculations they have to do, right? So there is a margin requirement for central government securities like the treasury bill and central government dated security, including the oil bond, but also for state development loans, the state government securities, there is a margin requirement. I hope you have understood. Now, one very interesting thing. Till now, the non-callable fixed deposits, you could not count them in LCR computation, right? Non-callable basically are those fixed deposits which cannot be broken. Non-callable fixed deposits, right? So non-callable FD, what is the meaning of that? A non-callable fixed deposit is a type of fixed deposit that has a lock-in period and there is no early withdrawal before the maturity date. And then you have a callable fixed deposit. Callable, you can withdraw early, right? So callable, then you will get less interest rate because you can withdraw early. You can have penalty also on that. But non-callable fixed deposit, the person cannot withdraw before the maturity period. So when you calculate the liquidity coverage ratio, so far till now, hitherto excluded in case a deposit till now which was excluded from LCR computation, for example, a non-callable fixed deposit is contractually pledged as a collateral to a bank to secure a credit facility or loan. Such deposit shall be treated as callable for LCR purposes and provisions that apply in the circular. What is the meaning of this? Well, let's say there is a non-callable fixed deposit of 2 crore rupees which a person has put in a bank. Now he needs money. No? Now he cannot break his FD. But what he can do, he can put this non-callable fixed deposit as a collateral in a bank, and against it he can take a loan. Now this non-callable fixed deposit which is put in a bank as a collateral and somebody has taken a loan against it, so far it was not allowed to be computed in LCR. But now it is allowed. So when calculating the liquidity coverage ratio, you can include those non-callable fixed deposits against which the loan has been taken. By putting them as a collateral, you can include them in your liquidity coverage ratio. So these you can include in your high quality liquid assets when you calculate your LCR. Now urban cooperative banks, they are of 4 types depending on the deposits. This is a 4-tier classification based on the NS Vishwanathan committee recommendation. So urban cooperative banks which have deposits up to 100 crore, they are tier 1. Between 100-1000 crore deposit, they are tier 2. 1000 to 10,000 crore deposit, tier 3, and more than 10,000, tier 4. Now why I am telling you this is because now, extremely important, there is a prompt corrective action framework that has come for primary urban cooperative banks also. So just like for normal banks, there is a prompt corrective action framework. Now even for primary urban cooperative banks, there is a prompt corrective action framework that we will look into it in detail. This is a circular that came on Kargil Vijay Divas, that is 26th of July 2024, and it will be applicable from 1st April 2025. So this framework, prompt corrective action framework, will be applicable to all the urban cooperative banks in tier 2, tier 3, tier 4, except the urban cooperative banks under all inclusive directions. What is the meaning of all inclusive direction? So all inclusive directions are some restrictions which are put by the RBI on some banks. All inclusive direction. So when a bank is prevented from discharging its liabilities by the RBI, issues these all inclusive directions when it believes it is required in the public interest. It should not be interpreted as a cancellation of a bank's license. The bank continues to work but with restrictions. So the PCA framework is applicable to tier 2, tier 3, tier 4, right? But it is not applicable to tier 1 urban cooperative banks. Very important question. The prompt corrective action framework will not be applicable to tier 1. Tier 1 urban cooperative banks, they have been excluded from the PCA framework for now, but RBI will keep monitoring them, but not under this PCA. Not under this PCA, right? Now, let us take a look at the prompt corrective action framework. And what is a prompt corrective action framework? In prompt corrective action framework, the RBI, if RBI feels that there is a bank which may default in future, it can put a lot of restrictions on that bank. Like it can prevent it from opening new branches. It can prevent the managing director from taking salary. I'm giving you some example, right? So there is a threshold that has to be reached before a bank is put into the PCA framework. So the PCA framework for the urban cooperative banks will be applicable from 1st April 2025. 1st April 2025. So what are the 3 criteria that will be used to determine whether a bank deserves to be in PCA framework or not? Capital, asset quality, and profitability. So for capital, we will see the capital adequacy ratio. For asset quality, we will see the net NPA ratio and net non-performing asset ratio. And for checking the profitability, we will see the net profit of the bank. Net profit of the bank. There is risk threshold 1, there is risk threshold 2, and risk threshold 3. The severity of the action that RBI will take against you will depend on which threshold you breach. So let us talk about the capital adequacy ratio. Let us talk about the net NPA ratio and net profit. So let us take a look at the first criteria, which is CRAR, capital adequacy ratio. Now what is the capital adequacy ratio? The CRAR for urban cooperative bank, it is 12%. For tier 2, 3, and 4, it is 12%. For tier 1, it is 9%. But tier 1, we are not concerned because PCA framework does not apply to tier 1. So look here, CRAR minimum regulatory requirement is 12%. If the minimum capital adequacy ratio should be minimum 12%. But if it is 250 basis point, up to 250 basis points below, which means what? 250 basis points you subtract from this 2.5, it becomes 9.5. So if it is between 9.5 to 12, which means risk threshold 1 has been breached. If it is more than 250 basis point but not exceeding 400 basis points, which means what? Which means it is between 8 to 9.5, then the risk threshold 2 is breached. If it is more than 400 basis points below, which means if it is less than 8%, then bank is in severe trouble. So risk threshold 3 has been breached. Now let us talk about net NPA ratio. Net NPA should be less than 6%, but if it is between 6 and 9, then risk threshold 1 is breached. If it is between 9 and 12, risk threshold 2 is breached. If the net NPA are more than 12%, bank is in serious trouble, risk threshold 3 has been breached. Profitability, if the bank is making losses for the last 2 years, risk threshold 1 is breached, and same applicable to risk threshold 2 and 3 also. Net losses for the last 2 consecutive years. Now, if for example risk threshold 3 is breached for multiple indicator, then action will be taken against the bank. Okay, so action will be taken and the bank will be put in the prompt corrective action framework. What action will be taken, that I will tell you in a bit. Now, what if the bank wants to come out of the prompt corrective action framework? Let's say some bank has been put under PCA. If it wants to come out of the PCA, then what? Well, then for the 4 quarters in a row, if there is a no breach in risk threshold, bank breached the risk threshold, right? But if there is a no breach in the risk threshold for 4 quarters in a row, then it can be put out of the PCA framework by the RBI. So what is the action? Now look, some actions are mandatory that RBI will take 100%, but some are discretionary. They will depend. RBI may take it, may not take it. So for example, if the risk threshold 1 is reached, then what are the actions that will be taken by the RBI against that primary urban cooperative bank? Against that, so the banks to raise capital either from the existing member or by issuance of equity and other permissible capital instrument. The people who own that cooperative bank, they will have to put their own capital in that. This is a mandatory action. Restriction on the declaration or payment of dividend. Bank will not be able to give dividend or any donation. Restriction on capital expenditure, etc. And these are action discretionary which RBI may or may not take. And these actions are of different types. Supervisory action, strategy related, governance related, capital related, HR related and all that. Risk threshold 2, if it is breached, then the branch expansion will be restricted. The urban cooperative bank will not be able to open new branches if the risk threshold 2 is reached. If risk threshold 3 is reached, then, well, there is a restriction on the how much deposits you can take. How much deposits you can take. And these are discretionary actions, supervisory, strategy related, will not go into too much detail, governance related, capital related, credit risk related, liquidity market risk related, HR related, profitability related, operations related, etc., etc. Will not go into too much detail in that. So this was the PCA framework for the Urban Cooperative Bank, extremely important. Now let us talk about the regulatory sandbox facility. Regulatory sandbox means when Reserve Bank of India allows you to test your product or service in a regulated environment, that is called regulatory sandbox. So 5th cohort of regulatory sandbox, 5th time RBI allowed the regulatory sandbox. The theme was what? Well, it was theme neutral. This time there was no theme as such. For the first 4 times when regulatory sandbox was enacted, there was a definite theme. So these are the 5 companies that got the approval from the Reserve Bank of India. Connecting Dot Consultancy, Apify Technology, Finag, we have IBDIC and Signzy, and they tested their different products. These are the products and services which they tested in a very, very controlled environment. So regulatory sandbox facility was started by the RBI in 2019, and it is for live testing of innovative financial products and services in a controlled environment under the RBI supervision. Now, RBI has put monetary penalty on 3 payment system operators, and we have seen payment system operators new guidelines in detail. So which are those? Well, Manappuram Finance, Ola Financial Services. These 2, the penalty was put for non-compliance with KYC norm. Manappuram Finance 41.5 lakh and Ola Finance Services 33.4 lakh. Not only that, Ola Finance Services and Visa, the penalty was put on both of these because they were not following the prepaid payment instrument guidelines. Okay, they were not following these guidelines. So what they were doing, card not present transaction, relaxation in additional factor of authentication for payment up to 2000 rupees for card network, provided authentication solution dated. Basically, there were some flaws in their prepaid payment instruments and authentication, etc. Additional factor of authentication. So you can see that 54.15 lakh was put on Ola for this, 54.15 lakh penalty, and 240.75 means almost 2.4 crore penalty was put on Visa worldwide for the same. Now let us talk about a very detailed report that came. I went through the report. It was some 200-300 pages, but I will cover the one only from exam point of view. So this is a report that came on 29th of July. This is called Report on Currency and Finance. So this is basically a report that says, what is the situation of India when it comes to digital technology. India is at the forefront of a digital revolution. Digital Public Infrastructure, DPI, we call it India Stack. Like you have DigiLocker, you have UPI, you have all this digital public infrastructure which benefits the public at large. So this report talks about the India's digital journey. So this is the report on currency and finance, India's digital revolution. Now this is a good MCQ. India's digital economy contributes 10% to our GDP, but look at this. By 2026, it will contribute 20% to India's GDP. Extremely important MCQ. Digital economy. What comes in digital economy? Well, e-commerce and everything that you see digitally is digital economy. So digital economy contributes how much to India's GDP? 10% as of now. Current contribution is 10%, but this will be doubled as early as 2026. And by the way, this report on currency and finance, it is published every year by the RBI. So it is an annual publication of the RBI. And what is the theme of the report? India's digital revolution. That you can see the theme written here, India's digital revolution. So what are the things which are said in the report? Internet penetration in India was at 55% in 2023. 55% is the internet penetration in India, right? And the internet user base has grown significantly. India has the cheapest internet in the world, 13.3 rupees per GB. You can say almost 13 rupees per GB. This is the cheapest internet in the world. It is lowest cost of internet anywhere in the world globally. In dollar, it is $0.16. But just remember a ballpark figure. Don't go into 13.3 to, just remember a very basic idea of the report. Okay. And India, if you see the per user per month consumption of data, it is 24.1 GB. So India's data consumption is one of the highest in the world. I'm not saying India's data consumption is the highest in the world. No, it is not. We are still a developing country. People don't have money, to consume endless data. Yes, data is cheap. Per GB data is cheap, but the data availability is less. So I know a lot of people who have like 2 GB limit per day, 4 GB limit per day, and when that limit is crossed, they stop. So that is why, but still India has one of the highest mobile data consumption in the world. So one user in India in 1 month consumes approximately 24.1 GB data. These are the figures given by GSMA. These are the latest figures. Now in India, there are 750 million smartphone users. 75 crore people in India, they are using smartphones. I'm not saying 75 crore people in India, they are using phones. No, that number is much higher. Smartphones, right? So 75 crore. And India has world's third largest startup ecosystem. India has more than 100 unicorn companies and India has more than 1.4 lakh startups. 1.4 lakh startup. Now this report also says that India, will cross, the digital economy of India will cross $1 trillion by 2025. So India's digital economy will cross $1 trillion by 2025. 2025. Now, remittances, we received a remittance of $115.3 billion in 2023. These are the figures given by World Bank also, right? And second was Mexico, third was China, and then we had Philippines. These are the figures given by World Bank. So how much remittance India received in 2023? Highest in the world, $115.3 billion. And by the way, this remittance will keep on increasing because lot of people from India, they are going abroad for working. India has population. That population is to our advantage when it comes to remittance. when it comes to remittance. So this the data remittance is important, and Mexico receives the second highest remittance, $66.2 billion, and China receives 49.5. Remittance is basically the money that those Indians who are working abroad, they send back to India. Then the report talked about the digital revolution of India, right? The digital revolution of India. So they talked about the digital revolution. The IT Act came in 2000. Then RTGS was introduced in 2004. NEFT came in 2005. The Payment and Settlement System Act came in 2007. NPCI was created in 2008. So some these milestones they talk about, right? They also talk about the digital financial innovation that has happened in the last few years. Reserve Bank Innovation Hub was set up in 2021. RBIH, which is a wholly owned subsidiary of the RBI. Now this is a good report. So you can see the population of India is 141 crore. Okay, how many people have Aadhaar in India? 138 crore people have Aadhaar in India. Now wireless subscriptions in India are how much? 1165. This is the wireless subscription in India. Internet subscribers in India are 95.4 crore. 95.4 crore people, they have internet subscription in India. Wireless subscription means what? Wireless means your 3G, 2G, 4G, 5G. This is wireless subscription. Phone subscription, network subscription. So 750 is what? 750 million smartphone users. So 75 crore people in India, they have smartphones. Social media users. So 46.7 crore people in India, they use social media. And UPI. So 42.4 crore people in India, they are UPI unique users. UPI unique user. And this is the data given by the Telecom Regulatory Authority of India. So take a broad idea, right? Now, if you see the internet penetration, it is increasing very fast. So the data consumption will increase very fast. Digital revolution will only multiply. India has the second largest telecom subscriber base after China, right? And India has the second largest internet user base globally after China. The average time that Indian users spend online is 6.45 hours per day. On an average, 6.45 hours is what an average Indian is spending online. This is close to the global average, which is around 6.4 hours. So we are there when it comes to spending the screen time, the online time that we spend, average Indian is 6.45 hours per day. Now you can see the India stack here. India stack means what? DPI, your digital public infrastructure. So for data exchange, we have Ministry of Electronics and IT, we have RBI, we have DigiLocker, we have account aggregators, we have all these things, right? For payments, we have again RBI, NPCI, UPI, we have all these NETC, your Metro card, FASTag and all these things. NACH is for recurring payment. Aadhaar enabled payment system, Bharat bill payment system. Then identity, we have Aadhaar, we have UIDAI, government department, we have Jandhan, RuPay, eKYC, eSign, GSTN. For DPI enabler, we have internet, mobile, data storage, computing. DPI principles are it should be open, scalable, common standard, public trust and private innovation. And you can see the Jandhan beneficiary and the RuPay cards in India. So the number of RuPay debit card you can see is more than 30 crore. More than 30 crore is the number of RuPay debit cards in India. They have exceeded by 2024 more than 30 crore cards. Now this report also talks about dark patterns. See, when digital revolution is happening, of course there are some problems also. One of that is dark pattern. Dark pattern is you try to cheat the customers in whatever way possible. So how many type of dark patterns are there? So for example, false urgency. Create a false sense of urgency to mislead the users into quick purchases. For example, if some company like Flipkart or Amazon says that, look, this sale is only for today, you will not get it tomorrow, then that is false urgency. You are creating a sense of false urgency. You are basically telling your consumer the sale is only for today, it will not be tomorrow. So you are this is a dark pattern. Okay. Then SaaS billing, exploiting recurring payment models in software services to charge users subtly. For example, if you subscribe to, let's say, Spotify, it will ask you your card number and it will auto debit money from your account every month, right? So that is called SaaS billing, software as a service, SaaS billing. Exploiting recurring payment. Recurring payment is there when you download something, when you buy something, recurring payment is there. That is also a dark pattern. Then forced action, compelling the users to perform unrelated action, proceed with their intended purchases. So if you compel users to perform unrelated actions so that they can purchase your products, so that is a forced action. Confirm shaming. What is confirm shaming? Using language to shame users into making purchases or continuing subscription. For example, if there is a website which is telling you you have iPhone 11, still shame on you. So that in a way they are telling you to upgrade your iPhone. So they are shaming you if you are, they are shaming you so that you purchase their products or you continue their subscriptions. Then bait and switch, advertising one outcome but delivering an alternate, often less desirable result. So if they, for example, say that buy our subscription and you will become a millionaire, but you buy that and obviously you will get a less desirable result, that is bait and switch. They are clickbait, clickbait. Drip pricing is what? They don't reveal the full price. You like a product, they will initially show you a less price, so you make up your mind to buy that product, but you will see there are handling charges, there are accessory charges, there are GST, this, that, and finally the product becomes very costly. That is called drip pricing. So you show the decreased price to the customer, you arouse his interest in that product because the price looks reasonable, but then when he adds it to cart, then when he goes to checkout, so many other charges are added. Similarly, subscription trap, making subscription cancellation difficult or hiding cancellation option. In fact, this has happened with me. I purchased an app recently and I don't remember which one, but it was so difficult to find how to cancel the subscription. And every year some 250 rupees they were charging me. So making subscription cancellation difficult, that is called subscription trap. Interface interference, what is that? Manipulative user interface to highlight certain information and obscure other detail. The website layout is such that some information will be shown to you, some will be concealed to basically force you into a purchase. Trick question, using confusing language or double negatives to mislead the users. That is also a dark pattern. Disguised advertisement, so posing the ads as other type of content to trick users into clicking them. You disguise the advertisement as a general content. Nagging, what is nagging? Annoying the users with persistent and repeated requests or interruption. Like for example, what happens on YouTube? If you don't purchase YouTube Premium, they will bombard you with advertisements, and then you have to purchase YouTube Premium. Otherwise, they will make you annoy so much. They will keep you showing ads and all skippable ads and non-skippable ads, and you will not be able to play it in offline mode. So many, you will not be able to play the video in background mode. So that is called nagging. Annoys them so much that they have to buy. Then basket sneaking, what is that? Adding items to the cart without user consent, increasing the total payable amount. So for example, if you have seen 100 t-shirts today on an e-commerce website, you want to purchase one, but when you go to checkout, one more will be added without your consent. So that is called basket sneaking. Rogue malware, so using malware or scareware to trick the users into paying for fake malware removal tools. Sometimes what they do is, like they say in antivirus industry, they put virus into your computer and then they sell antivirus. So similarly, they will put malware into your computer and then they will ask you to buy malware removable tools. Malware removable tools. And you can see this is the industry-wise distribution of the cyber attacks in India. Industry-wise distribution. Maximum cyber attacks in India happened in automobile supply industry. Automobile supply industry, right? So this is a data given by India Cyber Threat Report, Data Security Council of India. Data Security Council of India, right? So you can see that almost no industry is spared. You have the BFSI industry, somewhere around 3%, but highest around 13% is in automobile supply chain. In the government also department, you can see the cyber attacks are very high, 10%. Education sector also around 10%. Then you have around 8% in power and energy sector, right? So this is an industry-wise distribution of cyber attacks in India in 2023. Now, what is the cyber attack cost that India is bearing? So in India, the average cost of data breach was $2.18 million in 2023. And this is a 28% increase since 2020. And if you see globally, the cybercrime cost they will be around almost $14 trillion by 2028. In 2023, the cybercrime cost that the world had to tolerate was $8.15 trillion, which is more than 2 times India's GDP. And in India, the average cost of data breach is $2.18 million. Now, maximum cyber attacks in India were phishing attacks. Phishing attacks. What is phishing attack? So phishing refers to an attempt to steal your sensitive data, typically in the form of username, password, credit card number, bank account, etc. That is called phishing. So average cost of data breach in India is now $2.18 million in 2023. And the most common cyber attack in India, 22% was phishing. And as I said, India has the cheapest data, 13 rupees per GB. India also has one of the highest mobile data consumption in the world, 24.1 GB every month per user, and 75 crore mobile smartphone users in India. In fact, the number of smartphone users in India will become 100 crore by 2026. Also, in the next 5 years, India will become the second largest smartphone manufacturer. Now, another concern with digital economy is the UPI monopoly. So there is an index which is called Herfindahl-Hirschman Index, HHI of UPI, and this index gives you a score. Okay, so the score is between 0 to 1. 1 shows perfect monopoly and 0 shows perfectly competitive market. And the score for UPI is coming approximately, you can see, by volume and by value, it is exceeding at least 0.36. It is coming somewhere around 0.36, 0.37. So if it is approaching towards 1, it shows monopoly. See, the problem with UPI in India is that the Herfindahl-Hirschman index is very high, which shows monopolistic practices. So for example, almost 80 to 90% of the UPI in India is done by 3 apps. Most of it is by PhonePe, approximately 40%. Then second is the Google Pay, which is approximately 20%. And then you have Paytm, which is 11 to 12%. Now this data keeps on changing every day, but you get my point, right? So what the government of India has done is they have put a limit. Limit is how much? 30%. 30%. One company in India cannot have more than 30% weightage in the UPI. And this has become applicable now. Extremely important question. 30% UPI limit is there to prevent monopoly. Internet penetration in India was 55% in 2023, and it will increase very soon, right? Now I told you India received the highest remittance in 2023. How much did we receive? $115 billion, approximately that. But the remittance in India will increase from 115 billion in 2023. Look at this. The remittance will be $160 billion by 2029. Why? Because India has majority of the world's workforce. We have a high population. You know, for major economies of the world, the population is shrinking. The working age population is shrinking. So they need people from other countries to do the work. So the number of Indians who are going abroad for jobs is only going to increase. Now let us come to a circular which came on 31st of July. This is Aadhaar enabled payment system due diligence of the touchpoint operators. This you have to do. Aadhaar enabled payment system, you know, have you done it? So here your Aadhaar number and then biometric, they are used and you can make the transaction. So it is done through the Aadhaar enabled payment system touchpoint operators, right? So what is it is required to be done? So basically we have to make sure that Aadhaar enabled payment system is robust. There are no concerns of safety and security. So what can we do? Well, we have to do due diligence of the Aadhaar enabled payment system touchpoint operators. And this is only a draft. So master direction will come. They have invited the comments on this. If you have any comments, you can make, right? So the banks and NPCI, they have to make sure that the touchpoint operators who are right on the field, you know, they go to villages so that people can do Aadhaar enabled payment system. Their due diligence has to be done. So the acquiring bank, who is acquiring bank? The bank which onboards the Aadhaar enabled payment system touch point operator, like for example SBI. Now SBI, if it does not have a branch in any village, it can always send Aadhaar enabled payment system touch point operators So the acquiring bank or SBI shall carry out an updation of the KYC in cases where Aadhaar enabled payment system touchpoint operator has not performed any financial transaction for a continuous period of 6 months before enabling him/her to transact further. So if there is any Aadhaar enabled payment system touchpoint operator and he has not done any financial transaction in the last 6 months, then his KYC has to be done once again. Updated KYC has to be done. And NPCI and acquiring banks, they have to ensure that any Aadhaar enabled payment system touchpoint operator is onboarded only by one acquiring bank. They cannot share, two banks cannot share Aadhaar enabled payment system touchpoint operator. They cannot share it. So one acquiring bank will have only unique AIPS touchpoint operator. It is onboarded by only one acquiring bank. The acquiring bank will monitor the activities of the touchpoint operator on an ongoing basis, right? The transactional limit shall be set for AIPS touchpoint operator based on the risk profile. Transaction of the AIPS touchpoint operator shall be consistent with their location of operation and risk profile. And by the way, Aadhaar enabled payment system, it was started by NPCI. It was started by NPCI. So Aadhaar enabled payment system is what? It is a payment system in which the transactions are enabled through Aadhaar number and biometrics. Even OTP is fine. OTP is also done. So either biometric or OTP authentication is done. And what are the services in the Aadhaar enabled payment system? You can cash withdraw cash, do the balance inquiry, mini statement, cash deposit and fund transfer. These are the activities which are possible through the Aadhaar enabled payment system. So the most important is that if there is any Aadhaar enabled payment system touchpoint operator who has not done any transaction for the last 6 months, his KYC has to be done once again. Updated KYC has to be done once again. And two acquiring banks cannot share a touchpoint operator. So AIPS touchpoint operator has to be onboarded by only one acquiring bank. So that was the video. It was a slightly lengthy video, but then I have covered the full month circulars, and also the number of circulars were incredibly high. Also the circulars, there were a lot of circulars which had master directions, and obviously master directions, they take a lot of time in explaining, and a lot of time goes in such videos. I spent, I think, around 2 weeks because I have to make sure that I make you understand these very, very complicated circulars in a language which you understand. You know, you try once reading the circulars on your own, you will find out what I'm trying to say. I always give my best. Yes, videos can be late a bit, but I hope you understand that what I bring to the table is very unique and something that can actually get you selected in the exams. It's the content only, and only content that will get you selected in the exam. Nothing else will matter. So I appreciate your patience from time to time. So the second video of July banking awareness will come, but second video will have only the MCQs, and that's it from my side. Goodbye to you. Take care.